Open this hearing of the House of Representatives Standing Committee on Economics meeting for the review of the Reserve Bank of Australia Annual Report 2023. I welcome representatives of the Reserve Bank and thank them for coming to Canberra this morning, as well as members of the public and the media who are either here in attendance or watching on webcast. In recent years, the House Economics Committee has played an important role in scrutinising and holding the RBA to account as it pursues its dual mandate of price stability and full employment. Australians rightly seek assurance that the monetary policy decisions impacting their lives are being made with wisdom, prudence, rigour and the best available evidence. On Tuesday, the RBA board cut the cash rate target by 25 basis points to 4.1%, the first cash rate cut since the COVID pandemic. The major banks have all announced they are passing that cut on in full. These interest rate cuts will be warmly welcomed by most Australians, with so many people having struggled to get by under years of higher rates and other cost of living pressures. The latest inflation data has been better than expected and appears consistent with a narrow path to a soft landing, as we have discussed so often in these hearings. The committee looks forward to questioning the RBA today about its latest monetary policy decision and the path forward. In accordance with the committee's resolution of 9 August 2022, this hearing will be broadcast on the Parliament's website, and the proof and official transcripts of the proceedings will be published on the website. I remind all present that as Chair I will ensure that proceedings are conducted in an orderly, respectful and courteous way. Those present here today are advised that filming and recording by the media are permitted during the hearing. I remind members of the media who may be present or listening of the need to report the committee's proceedings fairly and accurately. Media present are also reminded to conduct themselves in a manner that does not interfere with proceedings, and they must not encroach into the committee's work area or film or photograph the documents or devices of committee members, witnesses or others. I now welcome representatives of the Reserve Bank of Australia appearing for today's hearing. Before you make an opening statement, could I please ask for the benefit of Hansard that each of you please state your full name and the capacity in which you appear before the committee.
Thank you. Michele Bullock, Governor, Reserve Bank of Australia.
Andrew Hauser, Deputy Governor.
Sarah Hunter, Assistant Governor, Economic.
Brad Jones, Assistant Governor, Financial System.
Thanks very much. I remind you that although the committee does not require you to give evidence under oath, the hearings are legal proceedings of the Parliament and warrant the same respect as proceedings of the House. The giving of false or misleading evidence is a serious matter and may be regarded as contempt of Parliament. Governor, I invite you now to make an opening statement.
Thank you very much, Chair. Good morning and good morning to the members of the committee. My colleagues and I are very happy to be here to answer your questions. So as you know and as you stated, on Tuesday the Reserve Bank Board decided to lower the cash rate target, which is our key monetary policy tool, by 25 basis points to 4.1%. The cash rate had been at 4.35% since November 2023. I'm going to start with some background to this decision, explain the Board's strategy, and I'll also talk about the outlook for the Australian economy and some of the risks and uncertainties. I'll then make some remarks on the payment system, including the RBA's consultation on retail payments regulation and the status of work in the cash distribution space. And finally, this week's meeting was in fact the last meeting of the Reserve Bank Board. From 1 March, the amended Reserve Bank Act 1959 will come into force, creating a new monetary policy board and a separate governance board. So I'm going to finish off today with an update on our preparations for these new arrangements and the implementation of the recommendations from the review of the RBA more generally. So as you know, the Reserve Bank's Board's mandate is to contribute to the welfare of the Australian people by delivering price stability and full employment. What is meant by price stability is set out in the Statement on the Conduct of Monetary Policy, which is agreed between the Australian Treasurer and the Reserve Bank Board in late 2023. To achieve low and stable inflation, the Board sets policy to return inflation to the midpoint of the 2 to 3% target range. But there's flexibility around the time frame in which we meet our inflation objective to balance this with meeting our full employment objective. That's achieving maximum level of employment that's consistent with low and stable inflation. The Board's strategy over the past 3 years has been to try bring inflation sustainably back to target within a reasonable time frame while preserving as many of the jobs created over prior years as possible. Now, looking back over the past 3 years, I think we can be satisfied with the progress made so far, though the job is definitely not done. Inflation has fallen substantially since the peak of 7.8% in 2022, and there's been welcome progress since we last met in August. Inflation was 2.4% at the end of 2024, and underlying or trimmed mean inflation, which removes the more volatile components of the index, was 3.2%. Underlying inflation has eased over the past 3 quarters, and in the December quarter it was a bit lower than we had forecast. This has increased our confidence that inflation is heading in the right direction. At the same time, the unemployment rate remained close to 50-year lows, and the share of the population with a job has risen to a record high. This is good news. Growth in private demand has, however, been weak, and wage pressures have eased. Collectively, this information suggests that higher interest rates have been working as anticipated, restricting economic activity and putting downward pressure on inflation. When we previously met with this committee in August, the cash rate target was at 4.35%. It had been at that level since November 2023, when the board increased the cash rate target by 25 basis points. At that time, there were signs of upside risks to the inflation outlook, so the board decided it was prudent to take out some insurance against those risks. The board's decision on Tuesday to unwind the November 2023 increase reflects its assessment that this insurance is no longer required. Looking ahead, the board is committed to being guided by the incoming data and our evolving assessment of the risks. While the strong employment growth is good news for job seekers, we are alert to the possibility that it is signalling a bit more strength in the economy, which could delay or derail the disinflation process. We have not pre-committed to any particular course of action on interest rates. But in the forecast published this week, the central projection suggests that if monetary policy is eased too quickly or by too much, disinflation could stall and inflation would settle above the midpoint of the target range. So the board remains cautious about the prospects for further policy easing. Our forecasts for the economy, which are conditioned on the market-implied cash rate path, have growth strengthening over the course of this year. The unemployment rate rising a little before stabilising at 4.25%, and underlying inflation coming down further to a little above the midpoint of our 2 to 3% target range from late 2025 onwards. Real earnings are also expected to recover. However, the economic outlook remains uncertain, and this is especially so the further we look into the future. Recognising this, we highlighted a number of key risks in the February statement on monetary policy. While our central projection is for growth in household consumption to increase as income rises, there is a risk that any pickup is slower than expected. If so, it would continue to weigh on output growth and could result in a sharper deterioration in the labour market than currently projected. Alternatively, labour market outcomes may continue to be stronger than expected, given the signal from a range of leading indicators. This could result in upward pressure on wages and inflation. A key uncertainty here is how much spare capacity there is in the labour market, since the answer to that will have a material bearing on the future path of inflation. We also hear from Liaison that weak demand has been putting pressure on business margins, helping to restrain inflation. As demand picks up, those constraints could ease and businesses might find it easier to raise their prices. More broadly, there are uncertainties regarding the lags in the effect of monetary policy. Another question is how firms' pricing decisions and wages will respond to the slow growth in the economy and weak productivity outcomes while conditions in the labour market remain tight. In particular, growth in unit labour costs, which is what matters for business costs, remains high because of weak productivity, even while wages growth has eased. There's also a lot of uncertainty about the global outlook at present. We're cautious about the possibility that global policy uncertainty may itself bear down on activity in many countries if households and firms delay expenditures pending greater clarity on the outlook. Our latest statement on monetary policy provides some scenarios to show different paths through which Australia could be adversely affected by changes to global policy settings. But at present, it's too soon to tell how this will play out. Before I move on to other areas of activity at the RBA, I want to assure members that the board is conscious that households with mortgages have had to adjust following rate increases since the pandemic. And the impact of high inflation over the past couple of years has permanently increased the price level. This has hurt everyone, but particularly those on lower incomes and more vulnerable. We've made good progress on inflation. However, the board needs to be confident that it is returning to the target range sustainably. Now, another critical area of work for the RBA is our regulation and oversight of the payment system. We're currently conducting a review of surcharging and merchant card payment costs, which I know has attracted considerable attention. We published an issues paper late last year and received over 90 submissions in response. There are a wide range of views set out in those submissions, and we've valued the strong engagement from stakeholders and the broader community in the consultation process. We're now actively exploring options to best support competition and efficiency in the payment system with the public interest firmly in mind, and we'll be discussing options and their trade-offs with the Payment System Board in early March. We aim to release a consultation paper in mid-2025 that will outline the board's preferred policy options and seek feedback. One other issue I'd like to bring to the committee's attention is the work we are doing to identify risks associated with the payment industry's intentions to decommission the Bulk Electronic Clearing System, or BECS. Now, this system may be unfamiliar to you, but it processes large volumes of critical payments, including pension and welfare payments and most of Australia's salary payments. BECS is considered a legacy payment system, but a transition away from BECS to more modern alternatives, if not carefully planned, raises risks for the reliability, efficiency and competitiveness of the payment system. We discussed some of our initial concerns publicly in December, following a period of extensive consultation with stakeholders. And next month we'll publish a report outlining our key findings and recommendations. Among these will be a recommendation that the industry and the government work to establish a shared vision for the future of these payments and establish coordination and governance mechanisms to manage the transition. It's in all of our interests that this issue is managed in an orderly fashion. Another issue I'd like to update the committee on is recent developments in the cash distribution system. While the use of cash for everyday payments has declined in recent decades, it remains an important means of payment for many Australians. Cash is used as a store of wealth, particularly during periods of economic uncertainty, and can be a useful backup for electronic methods of payment. The RBA is committed to supporting the Australian Government's policy objective to ensure cash remains a viable means of payment for as long as Australians want or need to use cash. As you're aware, the cash distribution system has faced considerable challenges over the past year or so. The key issue is that as use of cash for transactions declines, it's becoming more expensive to store, process and distribute cash around the country. At present, we have a single firm, Linfox Armaguard, that provides these services, and it has experienced financial difficulties because the revenue it's receiving for these services is not meeting its costs. In response, in June 2024, an industry support package of approximately $50 million over 12 months was agreed between Linfox Armaguard and its major banking and retail customers. This was designed to reduce the near-term risk of a major disruption to the supply of cash services and provide time for Linfox Armaguard and its major customers to improve efficiency and develop other measures to support Armaguard's financial position. Although there's been progress, there is still considerable work to be done to establish a model for cash distribution that is sustainable. The RBA has a specific role in the cash distribution system. We issue wholesale quantities of banknotes to the banking sector so that they can meet their customers' needs, and we provide incentives to the system to support appropriate banknote holdings and quality around the country. We're currently reviewing these incentives to ensure they're fit for purpose in the evolving landscape of cash usage. On the other hand, the logistics of moving cash to bank branches, ATMs and retailers is undertaken by cash-in-transit companies. Work towards more sustainable cash distribution arrangements is ongoing. Importantly, it requires cooperation across all industry participants with the needs of the community in mind. This appearance is our first since the Parliament passed amendments to the Reserve Bank Act late last year, which will take effect on 1 March. The amendments mean that the meeting of the Reserve Bank Board earlier this week was its last, drawing to a close 65 years of central bank history in Australia. Preparations are well advanced for the start of a new era of governance for the RBA, which begins on 1 March. In many ways, the new Monetary Policy Board will look very familiar to transitioning members when it first meets in March, but it will look noticeably different for those who served on the Reserve Bank Board in earlier times. Since the start of the year, the meetings of the Reserve Bank Board to deliberate on monetary policy have taken place over 2 days rather than 1 day. This has allowed the Board more time to carefully consider and debate the implications of the evolving information on the economy and financial markets and how best to respond. The Board has been closely involved in preparing the media release announcing its policy decision, and members are also more engaged with staff in the period between the meetings. And the papers prepared for the meetings include a greater focus on strategy, the options available to the Board, and the key judgments that underlie the staff's advice. This material is also reflected in our communications, including the Statement on Monetary Policy and the Monetary Policy Minutes. The most significant change from 1 March will be the establishment of the Governance Board, which will support the efforts we are making to lift risk management practices, oversee our large project portfolio, and assist us in meeting the challenges of a modern central bank. We recently held an induction briefing day with members appointed to the Governance Board, and it was clear from this that the RBA will be well supported by the new board. More generally, we've completed work on more than half of the recommendations of the review of the RBA and are well advanced on preparing responses to most of the other recommendations. As a result, there have been noticeable changes to the culture of the RBA, driven by a commitment to be more open and dynamic, which we'll build on in coming years. The Governance Board will report on our progress on implementing the reforms by the end of this year. These changes are all designed to strengthen our ability to do our work and enhance the welfare of the Australian people. So thank you for listening, and my colleagues and I look forward to answering your questions. Thank you.
Thanks very much for your opening statement. I was just wondering if you could talk us through how recent inflation outcomes compare to your forecasts, and in particular, if you could step us through what components of inflation are driving the moderation in both headline and trim mean?
So, headline and trim mean are slightly different stories. Headline inflation has come down substantially. A very large part of that has been due to subsidies, cost of living subsidies, which have been implemented by the government. Electricity subsidies in particular, but childcare subsidies is another one. So that's been driving a lot of the decline in headline inflation, which, as I said, is at 2.4%. Trim mean is coming down more slowly. What trim mean does is try to strip out some of the more volatile items and give you a bit more of a flavour of what's going on in the general inflation impulse. That's a little bit affected by subsidies as well, so there's some sense in which the decline in trim mean is reflecting some of those cost of living subsidies again. But there's been a couple of areas in which we've been quite encouraged. The first is that housing cost inflation has come down a bit more than we have been forecasting. Housing costs account for almost a quarter, 20-odd%, I suppose, of the CPI. So they're a very substantial bit, and they incorporate costs of building new homes and rents. And we've seen both of those decline a bit more than expected. The other area that we've been watching where inflation has been very persistent has been market services. So these are household services, they're things like insurance. These sorts of costs have been running at around about 4.5%, so they've been quite persistent. And in the latest data, we have seen that some of those components, not all, but some of those have come down a bit more than we were forecasting. So it's fair to say that the December quarter figures were a bit of a downward surprise for us. Some of it we can explain away with subsidies, others we can't necessarily, and we think that does reflect a bit less inflationary pressure in the system, and that's what's giving the board a bit more confidence, but not 100% confidence, that we are headed back to the band.
What quarter does the RBA expect trim mean inflation to return to the target band?
I think it's June.
So by the June quarter this year, you can see in our forecast we have trim mean inflation sitting at 2.7%, which is within the 2 to 3% band.
And at 2.7, it's pretty close to the midpoint.
It is. It's not the midpoint, but it is pretty close to the midpoint. That's true. And we expect it, broadly speaking, to hold there through the forecast horizon based on the underlying assumptions that go into the forecast and obviously our assessment of how we think the economy is going to evolve in the context of demand through the economy, but then also its supply capacity, which is where the labour market and productivity come into it.
I think it's worth emphasising too that we are aiming at the midpoint, and the reason we're aiming at the midpoint is that gives us the best chance to stay within the band. If we aim at just inside the band, then clearly the risks are that we'll pop out either side. So the point of aiming for that midpoint is that it does give us the best chance of staying within the band.
I'm just interested in your thoughts on some of the key risks in the global outlook, and in particular what might be some of the impacts of uncertainty around trade policy that we're seeing, principally from the US, but any observations more broadly also?
So I'll say a few words and then I might pass to Sarah, because we did do some scenario analysis which we reported in the Statement on Monetary Policy. I mean, the first point to make is that it is not only uncertain, it's unpredictable. What's policy one day is not policy the next day, so there's that. Generally, though, the direction of travel seems to be one in which world trade is going to be impacted in some way. Whether it be there's probably going to be tariffs, it's probably going to mean that trade patterns are going to change, supply chains are going to change, and that's going to potentially put downward pressure on growth in the world. Ultimately, Australia is a small open economy. We benefit from open world trade. And so this ultimately isn't good for us, and it's not good for us to the extent that it impacts on our major trading partner, China. Now, that said, we do have a floating exchange rate, which does take some of the heat, if you like. It does adjust in response to economic conditions and also what's going on in the world trading system. So we've got a little bit of a buffer there that will work for us. But nevertheless, ultimately, a situation in which world trade is there's friction and sand in the wheels of world trade, it's ultimately not good for us. I might, though, just pass to Sarah, because we did have a few scenarios in the Statement of Monetary Policy, and you can elaborate a bit.
Thanks, Michelle. Yes, so this is clearly a very fluid environment. So as Michelle has alluded to, even through the process of putting the forecast together, things were moving quite rapidly from one day to the next. So perhaps just to start with what we have included in the baseline forecast and then to talk to the scenarios. So the baseline forecast, and as it stands today, we've incorporated the tariffs that have been announced that will be put in place by the US on China. So those are included in our forecast assumptions. We're also expecting there actually to be a further escalation of that situation. In the context of the China forecast, we do also, though, expect that the authorities there will use fiscal and monetary stimulus to support the economy. And broadly speaking, we expect that to offset the drag from tariffs. That will mean a different composition of growth in China relative to what would otherwise happen. So they'll have a weaker net export position. They won't be able to export as much. A stronger domestic demand, which is where the fiscal and monetary stimulus will come in. But that's our sort of setting assumption for where we are today. That may or may not play out. We'll see, but we have to make some assumptions. In terms of the scenarios, what we were really trying to illustrate in the SMP is how we might see things play out and what that would mean for Australia. What I will say is the scenarios were very strict in considering just the dynamic with China and the impact of escalation of the situation between the US and China in terms of tariffs. We're very aware that it could be much broader than that. Clearly, US policy has looked at other countries and there's been announcements they've been walking back. We haven't included any of that in the scenario, but we are mindful mindful of it and watching it. Our broad assessment of any tariff-based scenario is that Australia is exposed, as Michele alluded to. We are a small open economy. We're dependent on the rest of the world. But we're in the, relatively speaking, lucky position that we're not as exposed as other countries. For example, the Bank of Canada recently ran a scenario exercise where they looked at what they thought might happen if there was an escalation of the situation between the US and Canada, so tariffs applied on both sides. They simulated and estimate some really very substantial negative impacts on their economy, something akin to what they went through in COVID. So really very substantial negative impacts. We don't think Australia is anywhere near that exposed. We wouldn't expect that to play out here. We wouldn't expect the tariffs to have the same impact. We're not as large a trading relationship with the US as Canada, for example. So there is a negative impact in terms of GDP, but it's in a relative sense small here, which is obviously somewhat reassuring. Other aspects of the scenario that we've explored, which are very uncertain, include how businesses and households in Australia might respond to these global conditions, what the impact of uncertainty is on decision making. One thing we can observe time and again through history is that uncertainty is bad for people making decisions. Businesses get a bit worried and they sit on their hands and they might choose not to undertake an investment project. That would be a drag on GDP. Households the same. If they get a bit worried, they decide to save a bit more of their income because they're concerned about the outlook. That becomes a drag on GDP. So we can see that channel in history, but it's knowing what the size of it would be. It's very uncertain, and it's obviously would be contingent on what policies actually happened. And then finally, in the context of the scenario, as Michele mentioned, we also looked very closely at the financial markets response, in particular the exchange rate. The exchange rate here, we obviously have a floating exchange rate, acts as a substantial buffer on some of those negative demand shocks that can come through from overseas. So to talk through that a bit, typically what we see is if there's a downturn in the global economy, so activity starts to weaken generally, the exchange rate will depreciate, and that supports our net exports. It provides a bit of a boost to our exporters, makes things a bit more expensive to bring in, so we perhaps import a bit less and we choose to consume locally, maybe holidays in Queensland rather than holidays overseas, for example. So that provides some protection as well. And because of that channel and because of these financial market impacts and the sort of that coming through in terms of a positive impulse for inflation, but perhaps the weaker domestic activity and the impact of trade dispersion putting a drag on inflation, we're not really sure what the net impact on inflation would be. It's very, very hard to tell. And one final comment I would make, at the moment, we've limited our analysis to tariffs and the trade channel. We're aware that there are a number of other policies being announced by the US government that will primarily have an impact on their domestic economy. The US is big, is important for the world economy, so as those play out, they will then ripple through to everyone else. We've not included those kind of assumptions in the scenarios that are in the SMP, but it is something that we're actively monitoring and looking at in terms of our analysis.
No, thanks. That was very useful. I mean, with situations like the one the world economy is heading into, I think generally economists will start with impacts on GDP, understandably, because that's a key measure of that impacts on people's welfare. And as you point out, Governor, I mean, if we're heading into a higher tariff era, that's likely to have impacts on GDP everywhere. But focusing on the inflation impacts, and Ms. Hunter, I think towards the end of your presentation, you talked about the fact that there are going to be offsetting impacts, and that, at least when it comes to inflation, it's difficult to pin down at this point. But would it be fair to say that with those offsetting impacts, that given that we have a floating exchange rate and other flexibilities in the economy, that we're relatively well placed to deal with those kinds of risks?
So the exchange rate certainly helps. It's what you might call an automatic stabiliser for Australia, and we've seen it work in that way in the past, and we would expect it to work that way again. I think it also comes back, though, to those are underlying trade patterns and the responses we might see in other countries. And I think one of the big differences between, I'll use Canada again as an example, between us and, say, the Canadians, is that their economy is so closely interlinked and interwoven with the US that shifts in that relationship, direct shifts, which is what we're talking about with tariffs, can have really dislocating impacts in the short term, and that's what can generate these big big downturns in their economy and have implications both for GDP and for inflation. Here, our trade patterns are different. We are obviously very closely linked to China in that regard as our largest trading partner, but our assumptions there around the authorities looking to offset some of that drag that I've talked about that we've got in our baseline forecast. That's what then flows back through to us and can dampen that impact. So it really does depend on how it plays out and how other countries respond. And we haven't even talked about other tariffs that might come in and relationships that might shift as well. But that difference in our trading patterns is quite an important part of this story, along with, as you said, the exchange rate. And that has in the past been a substantial buffer for us that's worked very well to dampen some of these impacts.
The bottom line, I think, is that it's definitely negative for growth. The impact on inflation is less certain, and it does depend. There might be, for example, as I said, we're a relatively open economy. We have relatively low tariffs and trade barriers, and if you get trade diversion, for example, so China can't export to the US anymore, they might choose to export cheaply elsewhere, and we might benefit from that. On the other hand, we might find that the exchange rate depreciates in response to that, which puts upward pressure on inflation. So it's not 100% clear. Suffice to say, the board are very focused on the uncertainty, and we think we know the potential implications for growth, but with inflation, we're going to have to watch carefully.
Yeah. Now, just a couple of questions on public demand, and then I'll hand over to the Deputy Chair. Firstly, this is something we've touched on before, but just to revisit a couple of themes, because, of course, like everything, public demand is evolving. But have the government's budget surpluses in the past two budgets been helpful in the fight against inflation, put downward pressure?
Well, let me just step back for a minute and make the point right up front. I made this in the press conference the other day. Our task is to fight inflation, and we're an independent central bank. The government's job is fiscal policy. It's independent of us. We have to take fiscal policy as given in setting our monetary policy, and we set monetary policy in response to what's going on in the economy at aggregate, which includes not only public but also private. And the private is very substantial, obviously, and consumption's a really big part of that. The government surpluses in the years following, the couple of years following the pandemic, I've described it in the past as we had some very fortunate international developments, if you like, that led to some good revenue increases, and the government basically banked those. And that was at a time when private demand was springing back very strongly from the pandemic, you'll recall. So we had a situation where public demand was, we had surpluses, it was sort of detracting in some sense, and private demand was really, really strong. So I think in that sense, it was helpful that there were those surpluses there, because at the time, the pressure on the economy, the pressure on the supply side of the economy from the massive increase in demand was evident in inflation. That was what was driving inflation. There was the supply chain issues and very strong demand relative to the ability of the economy to supply, and that's what drove that massive increase in inflation. Things have moved since then, of course. Private demand now has been very, very weak for some time at a high level, but it hasn't been growing very much, and the public sector has filled some of the hole that the private sector hasn't. So these things work together, but what's important is in aggregate what's happening to the economy.
And again, I think from previous discussions we've had in this forum, you've said that it's important that fiscal and monetary policy aligned, but that the central bank and the government have different functions, and fiscal policy should work with monetary policy, but it also has to achieve other objectives as well.
Well, I think fiscal policy needs, and it is, I think, the governments always are thinking about fiscal policy, setting fiscal policy in relation to the needs of the economy. And they're set independently. I've said before, the government has a lot of responsibilities with its fiscal policy. It needs to provide services that people rightly expect to receive from the government. So it does need to do all those things. It needs to balance a lot of things, juggle lots of balls. Monetary policy's focus is much narrower. It's on inflation, getting inflation sustainably back in the band while trying to maintain sustainable growth in employment. So we've got a relatively narrow remit. Fiscal policy has a wider remit.
Great, thank you very much. I'll hand over to the Deputy Chair.
Thanks, Chair. Thank you, everybody, for coming along. A busy couple of days, no doubt. I'm thinking back to, I was trying to place the exact meeting, but it was over a couple of meetings when your predecessor was in your seat and rates were going up. And we had a conversation and you talked about lag and how long it would take for those rate rises to be felt. And you sort of had anywhere between 6 months and 18 months or somewhere before that trickled down. It's a hard thing to look at. One thing he did mention at the time, though, that he felt it was slightly different and slightly more compressed when there were cuts. Do you have any view as to what that might look like? Do you share that view?
Well, the lags of monetary policy are really uncertain. It's really hard to tell. We feel, I think, that, well, I don't think there's an asymmetry in some sense. It's true that it might, to the extent that it might increase confidence of people. People have been saving a bit more than we thought they might. Consumption's been a little bit slower through our forecast period. We've noticed that we were forecasting as real wages have started to rise again. We were expecting consumption to start to rise again. It's been a little bit slower and soggier than we thought it would be. So it's possible that there might be some impact on confidence of a small decrease in the interest rate, but it's only small, it's only at the margin. But I know anything at the margin will be helpful for people. So, but I have no evidence to suggest that the lags are different on the way up or the way down. I think we still expect that it takes time for these things to pull through. So, yeah.
Perhaps to elaborate a bit on that with something of an example. So what Michele is talking about is obviously the sort of fairly quick impact on households, and you can imagine as well the cash flow channel. We know that that's going to flow through based on the bank announcements to mortgage holders in the next couple of weeks if it hasn't already. And certainly if you've got a savings account and the savings rate has been reduced by the banks, and as well that will come through on the other side. But to use another channel where it can take a bit longer to actually materially appear in the GDP numbers and therefore in the economy itself. We know that for developers or for individuals that might be thinking about building a home or building an apartment block or what have you, a lower interest rate, all other things equal, makes it cheaper to do the project, and that at the margin might let somebody push the button, as it were, and press go on a project that they otherwise wouldn't. If you push that button today, you might well be looking at 3, 6, 9 or even 12 months before you actually start any work. So maybe it's 3 months if you're building a single dwelling home, a lot longer if you're building a whole apartment block. And then it's after that point in time that it actually starts to appear in GDP and starts to have an impact then on the labour market and flowing through the economy. So that's another example of another channel where you can see the lags are much longer. We're not going to suddenly see more homes being built tomorrow because the cash rate was cut on Tuesday. And from our perspective, when we're looking at the transmission of monetary policy, we are looking right across all of these different channels. And that's why the lags are variable, and some of them are quite long, because it just takes time for it to actually get into activity, which is where we then start to see it showing up. So I thought that might be helpful as an example.
To specific investment's the other thing here. So it takes a while for demand to respond, and therefore that takes time before that feeds through to businesses thinking, oh, well, maybe I should invest now because demand's responding. So these are the reasons why they're long and variable, but in terms of whether it's asymmetric, I don't think there's any reason to think it's asymmetric.
Thank you. One of the things we've discussed throughout this term is the impact on interest rates on different cohorts. You talked about mortgage holders. I'm one of those, so I'll feel it rather quickly. But I guess two areas we talked about were renting pensioners and that 21 to 29-year-old no disposable income trying to save up to get onto the ladder. So this will be some time before those two areas, those two cohorts, feel any impact of this, and that would be over that period. And what's the weight of this going to be in their hand? Well,
the cohorts that have been mortgagees have been badly affected by the increase in interest rates. But the group that has been, I think, probably worse affected has been the lower income people who are renting. They've seen a massive increase in rents and they've also experienced massive inflation. So they're not going to necessarily benefit from the decrease in interest rates. They are going to benefit as inflation starts to come down, and it is coming down, so that's beneficial for them. And as the housing stock it's still not in balance. We've still got an issue with supply and demand for housing. But what we have observed is that rents are starting to come down, so that's really positive for them. Well, growth in rents is starting to come down. And one of the things we've noticed is that what's happened is that the average household size has risen quite a bit from where it troughed. So you can imagine that as average household size declines, that means that the given housing stock can house less people. So what I think we're seeing is that as rents have become very expensive because of the supply-demand imbalance, you've seen people make choices. Perhaps that study we wanted to keep now we'll rent out instead because we need an extra person in the house to help pay the rent. So there's these sorts of adjustments which are happening. So I think that cohort of renters on relatively low incomes, they're the ones that I think will stand to benefit as inflation eases quite a lot more, and the rental stock in particular gets a bit easier to rent. So that would be, I think, the group that often gets forgotten, I think. And I just want to make sure that people understand they are people that have really been hurt very hard by this.
No, very much. And so, yeah, this decision won't have too much of a felt impact on their lives. And I guess this goes as well to just going through your forecasts. You have real household income growth downgraded, I believe, for June 25 from 3.9 to 3.1. At the same time, we're seeing your expectations of population growth upgraded from 1.6 to 1.9. I mean, this is, you put these things together and we're starting to see the downgrading we've seen in standards of living rather continue for some time into the future yet. This isn't the sign of a happy, rosy turnaround just yet.
Can you comment on the downgrades?
I can indeed. It's so data at the moment has been very, very tricky for the ABS, who produce all of these numbers that you're mentioning, and for us to work with as well. So there's quite a bit going on underneath the hood actually on some of these data moves. In particular, what we got in the last national accounts data, which is where the household disposable income numbers come from, was actually an upgrade to the level in the history, but a bit of a downside miss in terms of what came through for the September quarter itself. So the level got lifted up, but the growth rate was lower than we were expecting. And so what that means is the level now is higher than we previously thought through the history and then carried through into the forecast. But growth in the near term, because we had that miss in the September quarter, comes in a bit lower. So it's not quite so, unfortunately, and I know we don't publish this in the tables, it's not so obvious that that's what's going on, but it's not actually quite the same as just a straight up downgrade in the level. Actually, the level's gone up, but the growth in the next 6 months in a year-ended sense will be a bit lower. In terms of population's also been really tricky. The migration burst post-COVID has been a challenge for all of us to track and to sort of see when we think it might be peaking. We work with our Treasury colleagues very closely on this from the Centre for Population Studies, and we also look at the latest data as well, so that our near-term forecast reflects the latest information that we have. It has been upgraded a little bit, as you mentioned, but we still expect it, obviously, over the forecast horizon to track back to CPOP's longer-term growth rates, which is what you can see by the end of the forecast horizon.
Thank you. Just to something a little bit different. Who made the decision to bring the cameras into the board meeting on Tuesday?
We did. We discussed it. It was the final meeting of the Reserve Bank Board. It was an historic occasion. And we felt that it was appropriate to mark that by just having some footage of the last ever meeting of the Reserve Bank Board.
Quite a few commentators took the view that the photos were I guess, evidence of the rate cut being confirmed leading into it.
No.
I appreciate that, but did you consider that as a risk and how that might be perceived?
No, because we hadn't made a decision.
Thank you. I'll just go to the conversation. I mean, you can probably understand the expectations in the market around, more interest rates cuts to come, given overseas performance, but obviously they took a very different view, and it's quite right and appropriate the RBA takes an Australian path for Australian solutions. But I guess there is the continued sort of question that you took at length to talk about the continued upside risks that there exist in the economy. Do you expect there to be continued expectation in the market of further interest rate cuts?
So there's a wide variety of views out in the market. Some think that we've made a mistake lowering the interest rate and that in fact we should be further increasing interest rates, and they hold those views very firmly. There are others who hold very firm views that we are in fact still far too tight and that we need to lower interest rates quickly and more. So you can pick your commentator, you can pick your forecaster. I think all the board are trying to say in this is that, and I set this out in the statement, we increased interest rates a bit further in November 23. People were not happy, but at the time there were indications inflation was surprising on the upside, it was persistent, the labour market was still looking pretty good, and so the board decided on balance that it was appropriate to increase a bit to take out a bit of insurance against that. The board has decided that actually now we are seeing some downside pressures, and they actually highlighted this in the statement in December. We didn't move in December, but we did highlight that we'd taken some comfort from some of the indicators. And this time we've got a little bit more confidence, so we can remove what we put on in November. We're back down to 4.1. That's still much higher than it was previously. But what I would say is that, and I've had to remind people of this occasionally, many other countries went much higher than us. They went up to over 5%. And they've come down quickly, and some of them now are around about where we are. And so, and they're now saying, well, we've got to be a little bit cautious now. And I think that we are in the position now where we might have some more decreases in interest rates, but we've got to be cautious. We didn't go up as high. We haven't got as far to come down. And I think we just need to be driven by the data, so that if the board is comfortable that inflation is heading back to target sustainably, not just popping in and then popping back out again, it's got to be sustainable, then that'll give them more evidence that they can perhaps nudge the interest rate down further. But we're not pre-committed. We're going to be data-driven on this, and I think people just have to be patient because, as I've said a number of times before, the inflation we've experienced over the last few years is what's really hurting people. I know interest rates hurt people who have mortgages, but inflation hurts absolutely everyone, and particularly those on lower incomes and more vulnerable. They are the ones that are hurt most by inflation. So that has to remain our target.
Are there specific, I guess, learnings, because the benefit of being slightly different to some of the other economies? If we look at the UK, with 3 cuts or 3 decisions that they've made, and now starting to see maybe a slight little uptick again, or the US going down a full percentage point, New Zealand 4 cuts, Canada 6 different decisions. Are there learnings that you are seeing, watching them, that are relevant to us? Well,
we are always looking for what we can learn from overseas. I think one learning from overseas is that the disinflation can be bumpy. It doesn't go in a straight line back to target. And you see this in the United States, you see it in the UK. The other learning I think I would take is that every economy is a bit different, and in some countries, like in particular New Zealand and Canada, they increased interest rates much more than we did. They've come down much more than we have, but their employment markets, their unemployment rates are actually quite elevated. They're going up and they're quite elevated. We haven't got that. So, you know, that suggests to me that at the moment we think, as I said, that maybe we're just on this narrow path we've always talked about. We didn't go up as high. We've kept the employment market strong. Can we continue to do this and continue to see inflation come down? That's what we're aiming at. And so far it looks good, but we don't think the job is done. There's more to be done here. I don't know if you wanted to add anything on the international side, Andrew.
No, I think you can always focus on the differences, but what I am struck by when you talk to other central bankers, we do a lot, and you're off to Basel quite soon to continue that conversation, is how many similarities actually many central banks are facing. We all had the very similar inflation spike in the last few years. We've all seen somewhat stronger employment growth, actually, than central banks have expected, but as the Governor says, the Australian labour market performance really does stand out. Now, obviously, there is an open question whether that's a triumph of performance, and we hope it is. But obviously, there is also the possibility that as we see stronger employment growth, we'll have less capacity in the labour market, and that puts some upward pressure on inflation. We've included some of that in our forecast. But I think sometimes people do focus on the differences. Actually, in many cases, central banks are talking about very similar issues, I think, globally at the moment.
Thank you, Chair. Thank you all.
Mr. Ray.
Thank you, Chair. Good morning, Governor. Can I just begin by noting that my community cautiously welcomed the interest rate cut this week. Obviously, people in lower socioeconomic communities have been struggling with mortgage costs, and people here are pleased to see that, you know, this is the latest step in a plan to address some of those cost of living challenges. So just some positive feedback, some moderately positive feedback for you. Can I just go back to the trimmed mean inflation? You've made it clear a number of times and over a long period of time, and quite rightly, I think the trimmed mean inflation is very much a key, or even not the key indicator, first amongst equals perhaps, that the bank looks at. I note that you've got the trimmed mean inflation forecasts significantly lower than they'd previously been throughout 2025. What I'm interested in you taking us through is just some of the assumptions, but particularly the assumptions around movement in cash rate that are considered in those forecasts.
Sure. So the way we construct our forecasts is we assume that the interest rate, the cash rate, moves along a path that reflects financial market pricing. So there's markets in which financial market participants basically trade on the basis of what they think the cash rate will be at various stages going out. So a year out, 2 years out, and so on. There's markets there, and we take that pricing from those markets and we put that into our forecasts. Now, the forecast, that particular, and it's an assumption. It's not a forecast for the interest rate. It's not saying what we will do. It's simply an assumption that we use to condition our forecasts. That assumption is for the interest rate, the cash rate, to have gone down to, where is the cash rate? 3.5 or 3.4, 3.5% by the middle of 2026. So that's another 75 basis points of easing, if you like. So that's the assumption. And the key point that is subtle here that some people have missed is that some people have made a point of saying, well, you don't get inflation back to the midpoint sustainably by the end of the forecast round. It's at 2.7, not at 2.5. Yes, that's right, with that cash rate assumption. So the idea there is that, at least on our central forecast at the moment, this is why we are cautious about how many interest rate declines there will be, how many cuts in cash rate there will be, because if you take our central forecasts at their word, then that says that if we drop interest rates by a further 75 basis points, we're not going to get back to the middle of the band. So that's why we're cautious.
Thank you. The market expectation at the moment is essentially pricing in another 2 25 basis point rate cuts just by the end of this year. That's right.
That's right. Yes, that's right. Yep.
So I don't want to verbal you, so I want to summarise so that I understand exactly the point that you're making, because I think it's an important one. So the bank's forecasts for inflation, trim to mean or otherwise, frankly, but let's use trim mean. The bank's forecasts for trim mean inflation include the assumption that is derived from market expectations that there will be 2 further 25 basis point rate cuts by the end of this year.
Correct. And another one in 2026, which is important as well.
Could I just add, to be absolutely technically correct, because markets move around all the time, and in particular they did move following the decision. We locked the forecast down last Wednesday, so the 12th of February. So obviously we have to go into production for the S&P. We can't be changing the numbers right up to when we publish it. So we locked it down on the 12th of February. So this market path was as it was just over a week ago. It is not the market path of today, because the market path moves all the time, frankly. If you're in the markets, I don't have to tell you this, but if you follow it, you'll see it's jumping up and down all the time. And in particular, it did move following the decision on Tuesday.
Yeah, that's a good point. Yep.
Thank you. That is a good clarification. Perhaps for the purpose of this conversation, let's use the kind of fixed point at which these documents and these assumptions were prepared, acknowledging that really important point.
Yep.
Respectfully, Governor, is there an incongruence between the bank using a forecasting methodology with an assumption for additional rate cuts, while at the same time projecting forward guidance pretty resolutely against those eventualities?
Well, we've got to use a forecast. We've got to use something in our forecasts. We've got to use some assumption for the interest rate. We could use an assumption that the interest rate doesn't change, it just stays where it is. And in fact, if we do that, and I think Andrew talked about this yesterday, if we do that, inflation declines and keeps going. It declines straight through the bottom. So that's another assumption you could use, which would be telling you, well, holding the interest rate constant for the next year is not actually going to deliver you inflation in the band either. So we've got to use something. We feel that this is the best assumption to use. It's a benchmark. And I want to emphasise that these are central forecasts, but if you look in our statement on monetary policy, you will see there are very wide bands of uncertainty around those forecasts. All models have bands of uncertainty around them, and one thing that you can probably tell with reasonable certainty is that you won't get the numbers, particular year or so out, you're not going to get the numbers exactly right. So I don't see any incongruence between about using this particular market path. It gives us a benchmark to say, what are we forecasting if the financial markets are right? And then we can then condition our thinking for what we do with monetary policy based on what those central forecasts tell us.
Okay, fair enough. But it is fair to say that, to kind of use that terminology that you've just used, the bank's best assumptions as part of their forecasting model is that there'll be another 2 rate cuts this year and a third one in early 2026. It's
not our best assumption, it's our assumption, and I want to emphasise it is not our forecast for the interest rate. It is not forward guidance. It is not saying that this is going to be the future policy path. It is purely a technical assumption for the purposes of getting out some forecasts which we can then use to condition how we're thinking about monetary policy.
And in fact, we are saying that if interest rates follow that path, inflation will not return to the midpoint of the range.
Yep.
So we are not saying, not only are we not saying that's our preferred path, we're saying that if it followed that path, we would not achieve our target.
Sorry, but you are saying that it will sit sustainably at 2.7%. Acknowledging that it is a forecast, you're saying it will be at 2.7%, which is solidly within the band. And as we acknowledged, only a small amount away from the midpoint.
A small amount away from the midpoint, but as I said earlier, our target is the midpoint, and the reason our target is the midpoint is it gives us our best chance, with all the uncertainties out there, of staying within the band. If we target 2.7, or well, why not target 2.9? The reason being, with the uncertainties around it, you're much more likely to end up out the top of the band in those circumstances. So that's why we do need to be targeting the middle of the band.
I think that's salient, but again, in summary here, assuming 2 further rate cuts this year, the RBA's current forecast is that we are within the target band.
Yes, that's right. That is correct, but we are not achieving, on the central forecast with the massive bands of uncertainty around it, we are not achieving the midpoint. Correct.
Acknowledged. Yep. I noticed that you've revised down the forecast for household consumption growth. Does that forecast also take into account market expectations for rate cuts, for further rate cuts?
No, again, the forecasts are conditioned on the market path, which is, as we said, 2 more rate cuts. Sarah already talked about the consumption forecast. They've been revised down because, in fact, the level was revised up quite substantially in incomes. So I think consumption...
Yeah, to provide a bit more colour to that, because it's similar to incomes, the household consumption data has been very challenging for the ABS just recently. So we have had some really quite substantial revisions to household consumption historically. I know this feels very esoteric and getting into the weeds, and I'm sorry, but it does actually matter in this case. So what we've had for household consumption, similar to incomes, is that the level was revised up substantially over the last 18 months in a series of revisions. But what we had also through those revisions was that the growth rates through the back half of 2022 and through 2023 were lifted, made stronger. But what we also got was downward revisions to the growth rates in 2024. We actually have a box in the SNP that talks through all of this, and this is why the box is there, because we know that it's quite confusing looking at just the forecast table. What that means is that when you get those downward revisions to the growth rates historically, the first couple of growth rates we report in the table, so December 24, obviously referring to the end of last year, and then June 25, the first sort of 6 months of this year, they've been pulled down largely by the historical data revisions. So it is true, we've taken another look at our household consumption forecasts. Going forward from here, we've factored in the market path. It does come through into disposable income. So if you're paying a mortgage and interest rates go down, you've got more money potentially to spend. If you're earning interest on your savings in the bank, for example, you'll have a little bit less. We take the overall net impact of those 2 channels, along with all the other determinants of household income, so employment outcomes, wages, other drivers of income. If you own your own business, that comes in there too. Putting all of that together, what you can see through the forecast is there was softer momentum through 2024. As I said, that's largely the historical data coming through. And then a pickup from there, which we've been expecting for a while, and that's underpinned by that improving real income outlook that I just talked to. So it's not quite what it looks like, and I'm sorry to go into the details on the data, but it's necessary in this case, I'm afraid.
But the bottom line, in answer to your question, is that yes, the interest rate path is in there, and that is impacting the amount of disposable income that consumers have. Yes.
So I guess my concern here is if inflation's settling within the target band, the current cash rate remains restrictive, as the S&P suggests. We see household consumption forecasts being revised down. Isn't there a growing risk that if there aren't further lowerings of the cash rate in accordance with market expectations, which then feed into your forecasts through those assumptions, that we run the risk of effectively overly restricting the economy and risk overshooting?
Yeah, and that's a risk that actually the board has called out, that in fact consumption doesn't recover as we're expecting in response to the increase in household disposable incomes. And in which case, yes, inflation will decline a bit more quickly than we've got in the forecast. So it's a risk. It's something we've directly called out, and we're alert to it.
Yeah, we've been monitoring it for quite some time. If you look back through the Statement of Monetary Policy documents over the last year, you'll see that risk called out quite explicitly in a number of those. Thanks,
Governor. Last question with my remaining minute. You've talked about the issues around unit labour costs. That's been an ongoing conversation, the upside risk to inflation. The ABS data on real unit labour costs indicates that the costs are sort of about or even lower than they were pre-pandemic levels. Doesn't this suggest that the change in unit labour costs have not actually been driving the inflation, given that there wasn't an inflation problem when they were at a similar comparable level prior to the pandemic?
So I think when we think about the drivers of inflation, you can sort of think of it coming through and manifesting through the economy in a number of different metrics that we track. So obviously the inflation rates, that's the obvious one to look at, and you can see it there. But when you think about what's underpinning that, it is the case that movements in output prices, that's inflation, consumer price inflation, that we're targeting, they will generally, speaking over time, track very closely to movements in the costs that business face. So unit labour cost is one of them, that's the labour cost component. There's other non-unit labour costs as well, of course, power, other types of energy. If you're a builder, you've got to get the raw materials that you need. This is part of your cost base. If you're a retailer, you've obviously got to bring your stock in, all those sorts of things too. And so what you'll see is that cost base, generally speaking, tracks in line with the final output price. So the movements in unit labour costs or in business costs more generally over the last couple of years have looked pretty similar on a chart to inflation. They tracked up very rapidly as we reopened from COVID. We had the supply shocks coming through then as well, obviously the conflict in Ukraine and the impact that had on things like fuel prices. And then they've both been tracking off in the last little while and coming back down. So it's not a case of any type of spiral or a wage price spiral or anything like that. That's not what we're seeing and that's not what we're expecting. But it is the case that those two things do sort of have to track together in a very sort of long run sense. It would be pretty hard for a firm, for example, to sustain cost increases of, say, 5% a year from year to year to year, and final price increases of, say, 2.5% from year to year to year. At some point, they're going to have their margins will go negative and they'll go out of business. You can't sustain that over time. So it's not a question of pushing and pulling. It's more a question of thinking about, well, the cost dynamics have to line up with the price dynamics in a very long run sense. And that's what we've seen over the past, and that's what we're expecting to see going forward. And if we look right now, notwithstanding the impact of some of the cost of living subsidies that are coming through into headline inflation, we can see that the cost base for, say, market services and some of those other domestic series in particular is still a bit elevated. And that's consistent with and congruent with the fact that their cost base is still growing a little bit higher than would be consistent with inflation at target. So those two things are in line with one another. They're not a surprise to see, but to the Governor's point, we've still got a bit further to go on bringing inflation back down. But we've obviously made a lot of progress in the last couple of years.
Thank you.
Thanks, Mr. Ray. I'll hand over now to Ms. Spender.
Thank you for your time today. I wanted to start with the recent data that's come out in terms of wage growth, unemployment and employment. I note that in your announcement on Tuesday, you said that you were waiting on more data as you consider future decisions. I'm interested in how those announcements, what your perspective on those announcements and what they make you think as the RBA.
So broadly, I'd say that the wages data, pretty much came in as we'd sort of forecast and expected. So it doesn't give us an alarm on the upside and it doesn't give us an alarm on the downside. And the labour market data, they still remain strong. And I think this is the main area that we are watching quite carefully. Some very loud voices actually argue that there is nothing inconsistent with this labour market and continuing to bring inflation back down. We remain a little bit more cautious. We do have, we think, still a tight labour market, but the extent to which that, and that's let me absolutely say this is a good thing. It's a good thing that people can get jobs. The question is it a little too tight to continue to bring inflation back down to the target and sustain it there? That's the million-dollar question. Some people think it is perfectly consistent. We're a little more wary. We think it's a little bit too tight, but we're constantly re-examining our assumptions on this basis. We're constantly re-examining and looking for signs that it might be reflecting in prices. We're not seeing it yet, but we're alert to it.
Okay. It sort of draws us to a conversation about Nauru and what that level is. I note in your forecast you've got effectively unemployment rate at 4.2, sitting well, but you have inflation at 2.7. I'm interested in how the board and the RBA is actually adjusting its models, how much it's adjusting its models in relation to Nauru, given what's going on at the moment.
So I'll pass for specific questions about the models to Sarah, but I wanted to make a few points right up front about Nauru because people focus very heavily on this one number. We need some sort of concept of that for our models, but our models aren't our forecasts. Our models give us somewhere to start, and then we think about whether or not these things make sense. We add judgment to them, and so on. So the models, we just don't take model output and plonk it into our forecasts. It's more subtle than that. The second point is that there is, rather than just one number that indicates how tight the labour market is, there are a range of indicators that we look at. And we sometimes set them out. I don't know if it's is the abacus graph in the statement. We've got this graph and it shows you all these different indicators. Some are lagging, they're excess capacity, unemployment, underemployment, these sorts of things. Some are vacancies, some are flows. There's a whole lot of indicators there. And so it's not a focus on a Nauru as such. It's more a focus on all of these different indicators that are, sometimes they're pulling in different directions. And it includes, very importantly, wages, growth of wages and inflation. What are we seeing in inflation? Because that's ultimately telling us how the labour market might be flowing through. So I just wanted to make it absolutely clear up front that a lot of people talk about the Nauru, and yes, it's got a theoretical concept and it goes into the models, but it's not the be-all and end-all, and it's not something that the board focus excessively on in thinking about the labour market. In terms of,
yes, sir.
Yeah, go on. If you wanted more detail on the models, I can pass to Sarah, but otherwise, yeah.
Well, look, I think it's not the models, as you say. For me, it's more this. It's more what the thinking of the RBA and the range of data you look at, and then also come to a question that a number of people have asked, which is that normally when you start an easing cycle, there's a very sort of a clear line in the sand which kind of drives that decision to start an easing cycle. I'm interested in the RBA's case. What were those? And I accept there are a range of factors you have to balance out there. What were the key sort of pieces that said, okay, this was the moment to start that easing cycle?
So there's a few things. I think the first is inflation. The inflation numbers have for some time now been coming down in line with where we thought they would be coming down, and in fact have come in a bit better. So number one, and in some of the areas that had held it up in the past, I highlighted housing costs and services. They came off a little bit more than we're expecting as well. So that's number one. Number two is that we have seen softness in private demand, and that has sort of been a little surprised us on the downside. So there's that as well. Wages have come in more or less in line when we were thinking, maybe a little bit softer as well. So there's all these sorts of things that... Now, what's also playing on the board's mind is that the board also doesn't want to be late. And arguably, we were late raising interest rates on the way up. We didn't respond as quickly as we should have to rising inflation. And I think the board has been quite cognisant of the fact, again, back to these long and variable lags, that if we're going to start reducing interest rates, then we need to be thinking of doing it not when we are already back in the band, but as we start to get more confidence we're coming back to the band. And in fact, if you look at the experience overseas with other economies, we are sort of the amount by which we are over our target is around about the same as other central banks were when they started to introduce their interest rates. Admittedly from higher levels, but they've come down a lot faster as well. So these are all the things I think that are playing into the board's mind. The other thing I mentioned earlier was that in November 23 we raised interest rates again, 25 basis points to the 4.35. We copped quite a lot of criticism of that at the time, and people said you've overdone it. We'd taken out a bit of insurance. We've removed that now because we think it's still a prudent move. But again, all those things I cited, we're going to need to see continued progress in all those things in order to continue to get more confidence that we're going to be sustainably back in the band. We think we're going to be back in the band this year, but again, it's not enough to be just back. You've actually got to be thinking you're going to be sustainably there.
Okay. I wanted to briefly touch on productivity because you certainly mentioned it in your remarks post announcement, saying, you know, one of the factors that you look at obviously is services, growth in services, services inflation, and productivity is a factor in that. I know that post pandemic it's been extremely choppy. But it seems to be surprising to the downside here. I guess it's I'll just get any perspectives on where you see it as productivity, and also what are the levers, given how vital a piece it plays in inflation and also easing the supply side pressures. What are some of the factors that you think should be things that perhaps are more on the sort of political side that we should be considering in relation to productivity?
So the first thing, I guess, in relation to is that we don't have a lever ourselves. Having said that, the best thing we can do to encourage productivity is to keep inflation low and stable. That's the best contribution we can make, which allows, because when you've got low stable inflation, you've got certainty for businesses, certainty for households about, inflation. I've often referred to it as inflation being in the background. It's not front of mind. And in those circumstances, I think businesses can start to think more about how they might improve productivity. Our forecasts don't see productivity picking up in the near term. I think we see it picking up about a year or so out to sort of about 1%, which is sort of pre-COVID norm-ish. But productivity has been declining over time. Not only in Australia but around the world, and in fact the productivity performance in Australia is similar to most overseas countries. The United States is a complete standout. Everyone else is experiencing similarly sluggish, if not declines in productivity that we are. In terms of what can be done, I'm not an expert in this. Danielle Wood is the person to quiz on this. But the things people typically talk about, and the Productivity Commission goes on about, are education, skilling up the workforce. Now, that's not just, I don't think that's just an issue about school and TAFE and university. That's important. It's also businesses being willing to invest in their people and skill them up and train them. And I think there is a sense in which, we've drawn a lot of people into the labour market in the last few years with this strong labour market that have been outside the labour market for some time. They're possibly lower skilled. If businesses invest in skilling them up, that will help with productivity. So that'll be good. Technology is another one that people always call out. I have no particular insights into that, but they're the sorts of things that government can do some certain things. Businesses can also take the lead in some of these things, and if businesses are incentivised to look for ways to increase productivity, and labour shortages might be one of them, and then ultimately you will see that reflected, but we're not expecting it to be reflected for the time being.
A question that perhaps Garth briefly sort of touched on sort of closely. Well, alluded to was there was obviously a really strong market expectation for a rate cut this week, and then for the bank in all your comments, it was saying, look, it was more of a line ball. Previously the RBA has been criticised for not for markets, for not giving enough guidance. And I guess the question is, if it was such a line ball, but the markets had priced it at 90%, is that a problem? And should is there a reflection in terms of should those expectations have been dampened down before Tuesday, given it was so close?
I think we gave signals in December in terms of our communication that we were looking, we'd noticed some good progress and that we were looking for good progress, and I think that was what the market was teeing off. But the market is the market. As Sarah said earlier, it does move around. And I think in our case, the market was rightly thinking that we were looking to whether or not we should start the easing cycle or not. So that they weren't wrong in that. When I say it's a line ball, and I don't think I use those words.
Sorry, I
think someone else used those words, but not me.
Yeah.
The tone I was trying to get across to people there was that, yes, there was good news on inflation and there were good reasons to think about staying to ease policy, but the board also had to think about what were the reasons why we might not as well. And so we had to have a vibrant discussion about that, which the board did on both sides, and then decided that the right thing to do was to lower the interest rate a bit. That was the board's decision. In terms of, should we be out there massaging markets? I mean, I worry a little bit that if you're out there too much massaging markets, I think the markets have a fairly good idea of where we're coming from here. But the problem is that the market path, or what the markets are saying, is actually a reflection of a large variety of views, some of which think that we shouldn't be lowering interest rates and some who think we should. So there's lots of people on both sides of that, and what you see in the middle is just the outcome of a whole series of individuals making calls on these things. So I don't think it was a problem in a sense. I think, but it was essential for us to get out and try to be clear about what the board's thinking was and why it had decided to move as it did, when it did, and what its prospects were for moving further. And the point there is simply we've got to be data-driven and we've got to be focusing on what the data are telling us about the inflationary pressures. I don't know if you have a reflection. No.
Okay.
So,
well, thank you very much. I'll hand back to the Chair. Appreciate your time today. Thank you.
Thanks, Ms Bender. I'll hand over now to Ms Lawrence.
Thank you. And you can hear me okay?
Yes.
Thank you. My apologies, I couldn't be there with you in person from WA, but I certainly appreciate the time that you've taken for us. Just reflecting into some of your opening remarks about the global forecasting, what would you describe as the RBA's forecast for Chinese growth, and what are the implications for the current outlook in the Chinese economy?
I'll hand to Sarah for the specifics, but the general idea is that we think that the Chinese authorities will respond to potential downward pressure on their growth rate from what's going on globally and their own economy. We're already seeing them responding, and we're expecting them to respond, and that's reflecting in our sort of central forecast for China that sees growth continue to, I'm not sure exactly what we've got in there, about 4.5, I think, which is, what have we got specifically for China?
Yeah, so to pick up on that and perhaps give a bit of context, which you're probably possibly aware of, the Chinese economy over the last 12 months or so has been through a bit of a soft patch domestically. They've had quite a long-standing now downturn in their housing market. That's coming through in prices, in the volume of sales, and in actual house construction. Their consumers have been quite cautious, so their recovery post-COVID has been quite subdued, a bit of a contrast perhaps to other countries. And what's been compensating for that has been a really rapid growth in their exports, particularly some of the manufacturing products, electric vehicles, solar panels, other technologies, particularly associated with the climate transition. What we've seen coming through in the last little while, a couple of things. One, some more data revisions. That's my theme for this session, I think, which actually suggests that perhaps their economy was doing a little bit better in 2024 than we thought. And overall, they hit around 5% for their growth rate for GDP, which was their growth target. So that's sort of underpinning it. And we've also had some both monetary policy stimulus. So that's the equivalent to reducing the cash rate, although they use different levers to engineer that in China. It's a slightly different setup for monetary policy implementation, but also some fiscal stimulus and support as well. They've had some schemes to encourage households to spend some money, and also some funding flowing out into the regions to support local governments. All of those things together mean that we now expect for this year their growth target for this year is again around 5%. We think that they'll probably sort of reach that. But then, as Michele mentioned, we do think that it's going to moderate down to 4.5% and probably keep going and tracking down into the back half of this decade. That slowing in growth really reflects, to a large part, their demographic transition. So their economy now, they have a shrinking working age population, and they're near enough having a shrinking actual population that's reflective of their demographic policies of earlier decades, and one-child policy in particular. And that really then pulls down on the pace of absolute growth in your economy. If you've got a shrinking workforce, you just can't make as much stuff, and there's not much you can do to fight that either. So that's really what that underpins the slowdown in the pace of growth there over the medium term. But for the near term, we're expecting the sort of current rate of momentum to broadly hold up. And as I said earlier on, that fiscal and monetary stimulus is not just in response to their domestic conditions. We also anticipate that they'll provide further support as the impacts of the tariffs that have been imposed begin to flow through. So we should see a change in the composition of growth as well, less export-driven, more domestically driven.
And do you feel that, I appreciate it's relatively still early days, but with BRICS looking at alternate payment systems, do you feel that might have a bearing on the RBA's considerations at all, or not sufficient?
Not the payment systems themselves. I think the work that the BRICS are doing on their the way that they pay one another and their payment systems, I mean, that underlies the commerce, but I don't think it's going to have a massive impact. I mean, the US dollar is still predominantly the currency of choice for international trade. I don't think the payment systems drive trade, put it that way. I think that's not really going to have a particular impact on the trade. It might. I mean, they are certainly. It's reflective of a more general view that they are looking to form their own sorts of groups and perhaps trade with one another. But the payment system itself, I don't think so. Okay,
and just in terms of the components that you think are driving the moderation to inflation. You spoke a little bit at the beginning, but can you just elaborate a little bit further about how you feel the drivers themselves and what are the components that you feel are moderating the inflation?
So might be worth just having a little bit of context and go back to where we started from at 7.8%. So there was a few things going on. So in the pandemic, there were lots of supply chain issues. So you couldn't get goods into countries. There was trouble. I tried to buy an office chair at one point and couldn't get my hands on one anywhere. So there was lots and lots of these sorts of things going on. And at the same time, there was elevated demand, and that demand was elevated for two reasons. One, it was a particularly elevated demand for goods because people in the pandemic couldn't go out and spend any money on services. They couldn't go out to lunches, you know, or sporting events or anything like that. So they couldn't spend money on services. They had all this money, and then the governments all around the world were providing help to households because many households lost their jobs and so on. So there was this increase in demand for particularly goods at a time when we had supply chain issues. So the first bit of the decline in inflation, a lot of it was related, and there was energy as well. There was the Russian invasion of Ukraine and energy prices went through the roof. So as a lot of these supply things unwound, there was a natural decrease in inflation. But as I said, there was also an underlying demand issue there, and particularly when we came out of the pandemic, demand for services went up dramatically because people hadn't been able to get out and do things. At the time where there were shortages of labour, and labour is a big input for services industries, obviously. So we had this tension of lots of demand for services, holidays, travel, eating out, sporting events, nail salons, whatever, all the sorts of things you couldn't do in the pandemic, and there was a shortage of labour. So prices and inflation was quite elevated in those. What we're starting to, and another big area of particular inflation was housing costs. There was really elevated costs of materials, some of it because they're imported, but also issues with supply of labour in those industries. So there was lots and lots of inflation in those areas. More recently, what we've seen is that the housing cost inflation is starting to moderate a bit more quickly than we thought. It's coming in, I think, because there is a bit more availability of labour in some areas than there was. Certainly energy costs and some of those input costs have come down as well. And then in the services areas, I think we are starting to see a little bit of a settling down. It's still elevated, but in some of those services now we are starting to see inflation in those areas start to moderate a bit more as well. As demand's levelling out, people are sort of going back to more normal patterns, but there's also cost of living pressures now, so some of these things, again, monetary policy is having an impact there because it's putting pressure on demand, which means that's meaning that the services industries can't necessarily increase their prices as quickly as they could. And as I said, there is some indication in liaison that margins are being squeezed a little bit here. They can't pass on as much as they used to. So they're the sorts of areas I think we're starting to see it.
Sure. And the forecast for the RBA for a trim mean to 2027 is, as I understand it, sitting at around 2.7 instead of the goal of 2.5, and of course within the band of 2.2 to 3. But I'm just wondering why that you're thinking out to 2027 that it will still be at 2.7 and not even say to 2026. Like if you could just explain that a little bit further.
Well, first point to make is that actually when you're going out that far, forecasts are increasingly uncertain. And if you look in the statement on monetary policy, you see the bands of error around those forecasts rise and rise as you get further out. So that's the first point. We're much more uncertain about those forecasts the further out we go. The basic reason it pretty much just flatlines there is that with the recovery in real incomes, recovery in private demand, what we basically see is that demand and supply are pretty much moving together. So you see deflationary pressure or disinflation pressure when demand is growing more slowly than supply, and it's actually hopefully not above supply. That's when you start to see those pressures abate. So correct me if I'm wrong, Sarah, but this basically reflects that as we go out there, the forecasts are for demand and supply to be pretty much increasing together.
Yeah, no, You'll find in the SNP, when you read through the text, and I realise it's a long document to get through in just a few days, but we make reference to the fact that we think through the first half of this year we're going to start to see a bit of a pickup in private demand. We think we've seen the first signs of that towards the end of last year, but as we talked about earlier, we are constantly watching and we're very cautious on how that might play out, particularly for households. But our baseline forecast is that we do see a bit of a pickup for household growth in household spending. And then by the time we get towards the end of this year and then into 2026 and then the first half of 2027, as the Governor said, we think that demand and supply are really going to track in line with one another. And that's sort of going to hold inflationary pressures stable. You don't get any disinflation. We don't have any reinflation either. So we don't have a pickup in the inflation forecast. But these are the risks that we're monitoring and looking at very closely on both sides, as we've also discussed earlier.
So just to my last question then, in that context, why would you suggest that the major banks are forecasting a further 3 rate cuts? Is it big? Are they? And if I can, appreciate you trying to aim for maybe a midpoint now as opposed to within the band, but I'm just wondering if there's a disconnect in the goals are a little different.
So it depends on, I said earlier that there are views on both sides. There are some views, and some of the bank economists have a slightly different view about us than the labour market. So there are some out there that think we are overestimating the extent of excess demand in the labour market and that inflationary pressures emanating from that just aren't there. They have a fundamentally different view than we do on that. I would say, though, that there are others out there that are saying interest rates are still too low. You did the wrong thing in lowering the interest rate this week. There is still far too much inflationary pressure in the economy. You should be increasing interest rates. There are people out there still saying that, or at least not decreasing them.
Oh, the Leader of the Opposition suggested it too, didn't he?
So, I mean, it depends on the particular bank economist that you're talking about, but basically it boils down to a difference of view, mainly about the labour market, I think, is the bottom line. They have a different perspective on the labour market. And look, we're alert to that. We are doing a lot of work in examining their arguments, trying to figure out if they're perhaps more right than we. Are we too concerned about the tightness in the labour market? But, as I said earlier, there's a variety of indicators that we look at in the labour market, and all of those indicators, and even the forward-looking indicators and our business liaison program, which we talk a lot to businesses, and they all tell us that still there are difficulties getting labour. So notwithstanding these differences of opinion, we are examining it, but we still are of the view that it's tight, and we think it's tighter than they do, I think.
There is also a view in the market, I think, that when central banks move rates, they keep going. And that is true on average across time and across central banks, but it's not always true. And there have, at times in Australia's past and other countries as well, been very shallow rate paths, maybe one move up, maybe one move down, and then a period of stability, and then either moving further or moving the other way. It's a sort of norm that in trading in markets that once you see central banks move once, they'll keep going. And what we've been very clear about is that every cycle is different. And at the moment, as the Governor has said, we take a somewhat different view about capacity in the labour market. But I think it's really, really important. We could be wrong. We're being open about that. We set out in some detail in our documents how we could be wrong. We listen carefully to people that criticise us on that. And if we're wrong and inflation moves more quickly downwards, well, you could celebrate that fact and policy will need to respond. But we'd rather wait and see than assume that's what's going to happen.
And I guess, from what we're hearing, if people are only spending 25 cents in the dollar of their tax cuts, it would suggest that consumers' spending is much more conservative, perhaps, than is being forecast.
I might just comment on that. So the tax cuts came in on the 1st of July, so we've had them for just over 6 months now. When they, ahead of them coming in, and they've been legislated for a long time, so we've had plenty of time to prepare, we weren't expecting households to spend all of those tax cuts straight away for a couple of reasons. One, because actually at the moment the savings rate is positive. So it's always true of any given dollar of income, on average households spend most of it, but they always save a bit of it. So we wouldn't expect them to be spending all of it anyway. And two, much more importantly, empirically what we've seen over time here in Australia, but also in other countries, is it takes time for households to respond to a step change in their income, such as a tax cut like the one we've just had. So we were always anticipating that it would only be some of the tax cut that would be spent, not all of it. What we've seen come through, we think, for the December quarter. We don't know yet because we don't have the data. We get that in a couple of weeks. But what we're expecting to see when we get the December quarter data is, to your point, it is around about 20 to 30% effectively will have been spent. If that's what happens, that will be in line with what we were expecting. So we weren't anticipating it to be more. What we think is going to happen from now on is that as household incomes continue to rise, household spending is going to broadly track that. So the savings rate will sort of hold steady, and households, they'll see gradual increases in their income as their wages might go up on their annual pay resets. Maybe you change job and you get a slightly higher pay rise or what have you, and that flows through into spending in a sort of more normal pattern, because we're not anticipating any other step changes in income such as the tax cut. So we've been generally surprised by households over the last couple of years where they've had softer spending than we anticipated, although some of those earlier, I was mentioning data revisions, some of those have helped to explain it. We just didn't know about them at the time. And going forward, we're expecting it to be what I might call a bit more normal as a dynamic as things basically settle down. So we'll see what we get, and we're constantly monitoring it. But if what you said is what the data gives us in a couple of weeks, that won't really be a surprise to us. We were anticipating a similar response to the one you mentioned.
Thank you, Chair. Thank you.
Thanks very much. Well, congratulations on surviving the first half of the grilling. We'll now suspend proceedings for a short break and resume at 11:25. Okay. Thanks. And I'll hand over to Ms Payne.
Thank you, Chair. Thank you very much, Governor and team, for being here in Canberra with us today. Appreciate you being here, particularly in such a busy week. I just wanted to, I know, sorry, that we've touched on some of this, but wanted to talk a bit about how our policy has compared with other countries. So how does Australia's current policy rate compare to comparable economies?
So, depends on which comparable economies you're looking at. If you're, at the moment, our policy rate is around about the same as in the United States. I think, yeah, there's the graph there. I think the UK has a similar-ish to us as well, around the ballpark. Europe, New Zealand and Canada in particular are a bit lower than us. Everyone is reacting to their own economic conditions. I had pointed out earlier that a number of countries, including the US, the UK, Canada, New Zealand, all went up much further than we did. They went up to around about 5 or a bit over 5%. They've come down quite sharply since then to around about, a bit over 4, and in New Zealand and Canada's cases below that. So that's sort of where we compare at the moment on relative interest rates.
And are there things we can draw from a comparison of the impacts or other indicators in those economies where they've been, where they are lower than us?
So the situation with Canada and New Zealand is that their labour markets are actually worsening. They've got a high and rising unemployment rate. So they've got a different sort of economic situation. Where we stand out relative to some of the other countries is that our labour market has held up much, much better than many other countries. Leave the US. The US is doing well as well. But if you look at some of our peers, including, say, Sweden, Canada, New Zealand, UK, our labour market has generally held up much better than theirs.
Thank you.
The Canadian unemployment rate is 6.9%. I hesitate to guess what the debate in Australia would be like if unemployment here were not 4 but 6.9.
Yeah, thank you. That answers what was my next question. So I'm also interested in, and I know obviously this has been discussed, but just to drill down a little deeper on how interest rate rises have been felt through the economy, and what we know about how households have responded to rising interest rates. Obviously, we had a cut at the last week, but have households cut on discretionary spending only or non-discretionary spending? So,
might just step back a bit and say the way monetary policy works. In Australia, everyone focuses on what we call the cash flow channel because we have variable rate mortgages. Many other countries don't have variable rate mortgages. They have varying degrees of fixed rate mortgages. The most extreme is the United States, where they have 30-year fixed rate mortgages. So interest rate changes from the Fed don't actually impact mortgage interest rates in the United States. Having said that, monetary policy works in the United States. So it's quite clear that there must be other things going on with monetary policy. It's not all about the cash flow channel, which is the one we tend to focus most of our attention on in Australia because we have predominance of variable rate mortgages. So yes, it works through a cash flow channel. It also works through what we call intertemporal substitution. So when interest rates go up, it encourages people to save. And when interest rates are really low, people are less encouraged to save and they tend to spend more now. So it impacts the way people think about, do I spend now or do I spend later? And you can see that has an impact in our case because you'll see that particularly in the housing market, again, is a very good example. If your mortgage interest rate's gone up from 2% to 6%, you're encouraged, if you've got some extra income, to try and pay that down quicker. So that's sort of an example of where people might be. So it works through that process of intertemporal substitution. It also works in our case through the exchange rate. Now, in this case, the most recent case, everyone was raising their interest rates. And when our exchange rate depreciates, that's sort of a positive impact for our economy, and when it rises, then it sort of has a contractionary impact on the economy. And in normal times, if we were raising interest rates and no one else was, that would help also to pass through a contraction on the economy. So that's another channel through which monetary policy can work. So there's all those different ways. Now, having said that, your question sort of relates to what I'd loosely call the cash flow channel, which is as you put interest rates up, it impacts the amount of money that mortgage holders have to spend. And yes, I think the answer is that we have seen that discretionary spending in those sorts of households has been impacted. So they have tended to cut back on and one person's discretionary spending is another person's essential as well. So it's sometimes a little bit difficult to get a handle on that. But broadly, I'd say what people have done is, in order to continue to meet their mortgage payments, which people put a lot of stock on, they have cut back on the discretionary items that they feel they can cut back on. So that's been one. It's also worth remembering, though, sorry, long answer, that interest rates impact people in different ways, and this is part of, I think, the angst. Interest rates going up hurts people with mortgages. People who have savings, their interest earnings go up. So there's different people in the economy that get impacted in different ways. It's always been that way. It is a blunt instrument, the interest rate. We recognise that it impacts people in different ways, but the bottom line is that we've observed that in putting interest rates up, we have had the desired impact in tempering demand and bringing demand back down again, and that is having the desired impact on inflation. As I said, it's not one yet, but that's what we're working on.
Thank you. And obviously early days, but in terms of the rate cut this month, do you anticipate how households will respond to that?
It's a bit difficult to know the specifics of how they'll respond. Some that are under particular pressure may find that they just go out and spend it. One thing we do know, though, from our data on mortgages is that consumers do like to pay down their mortgages more quickly if they can. So we do know that not all households, but a large share of households do have buffers on top of their required interest payments. So they've got a certain amount to pay in terms of principal and interest. And then a large chunk of them also put extra away in offset and redraw accounts. And so how they respond might depend on whether they decide to put it into savings or they choose to spend it. And that will depend, I think, very much on whether or not they feel that they are they want to do some more discretionary spending, or they just didn't have enough for their essential spending as well. So it's going to depend, but at the margin, it's ultimately helpful for cash flow for those people.
Thank you. And would you mind talking through the case that led to the cut this month? Like what made this month the time to do that?
So I think you have to go back to, if I start back in November 2023, and hopefully it'll be obvious why I think we need to start there. In November 2023, we had some upside surprises to inflation, quite substantial ones. They were material overshoots of our forecasts. The inflationary pressures seemed to be more substantial than we thought, and we raised interest rates by 25 basis points. And at the time, we said that we were being prudent. We felt we needed to address the upside risks, so a small increase in the interest rate would be appropriate. Since then, and we've kept the interest rate on hold, and most of that period we were stressing that there were risks on both sides, and that we felt we needed to be much more certain that the disinflation process had started. By December, we had received some data that suggested to us that there were some things like private demand, wages, some of the inflation prints. Everything was coming in a little bit softer, and that suggested to us that we could relax a little bit on the upside. And so when this time came around, we had a particularly favourable inflation print. We were continuing to see, demand wasn't taking off in any way. Wages were being well behaved, and we felt that there was an opportunity to take off that 0.25 percentage point that we'd put on in the first place in November 23 to bring it back down to where it was. Now, you could argue that we could have stayed where we were. Andrew alluded to the fact earlier that in our forecasts we have interest rates declining quite substantially. When we do internal scenarios, if we kept the interest rate where it was for the foreseeable future, it's highly likely that inflation, we'd be putting too much downward pressure on, and inflation would be starting to come through the bottom of the band. So what the board were weighing up was hold for a bit longer and hold to see perhaps some more labour market data, some more inflation data. The national accounts come out soon. There's always more data. You can always say, we'll hold just until we get more confirmation, more data. The problem with that is that at some point you're probably going to be too late. So the board decided in the end that taking off just 25 basis points and then sitting and waiting for more data was the best thing to do. It's the most appropriate thing to do. Recognising that there are still risks on both sides, but it was a recognition that some of the indicators at least were coming in for us slightly softer and good news for inflation.
Thank you. I want to just switch now to a couple of questions on the RBA review. What changes has the RBA made to incorporate the new boards?
Well, we're still in the process of doing that. So the new boards, the Monetary Policy Board has got 4 members who are moving from the current board and 2 new members, and the Governance Board has 2 members from the previous Reserve Bank Board and 4 new. So each board has some new members, and the Governance Board, we've had an induction day. We've drafted charters, memorandum of understanding between the various boards, because there's a payment system board as well, so we've got to bring them in. We've onboarded all the new members. We have, for the Governance Board, which is the brand new board, we've worked up the sorts of reporting, the sorts of agendas we're going to have. We've set the meeting dates, and we're establishing an audit and risk committee. So there's a lot of work going on there. That's going to change over time, I suspect. It's the first time we've had one of these boards. We'll set it up, but it's going to take time to embed it and embed it in the organisation and how the organisation relates to the board. What sort of reporting the board is interested in, where are they interested in focusing their attention. The Monetary Policy Board will be a little different. It will continue what it's doing now with its 2-day meetings, the board papers and so on, but what they won't be doing anymore is seeing any sort of other matters like work health and safety or reports on operational incidents or anything like that. They'll be out of that now. All their focus now will just be on monetary policy.
Thank you. And are you able to give an update on any other changes that have been made to accommodate the review?
Yeah, so a number of things. So we've launched a new culture ambition. So one of the points of the review was that we were a bit too insular and we didn't consider outside views and we didn't have enough internal discourse and debate. We've launched a new cultural ambition, open and dynamic, and leaders are expected to model this. It means listening, and it means real listening. It doesn't mean, listening while you figure out what your next argument's going to be. It means listening to what we're hearing from outside. Andrew has already mentioned the fact that there's a lot of debate, particularly around the labour market. We are engaging with that. We are trying to we are not assuming we are right. We are trying very hard to challenge ourselves. So we're very much working on that, both an internal discourse that welcomes curiosity and challenge, and also externally, so I think that's really important. Another big area of work for us is risk management. We haven't traditionally been very good at risk management. It's not that we're not good at it, it's just that we haven't managed to embed it into our operational decision making as well as we could. So we're doing a lot of work on that as well. That's not as explicitly related to the RBA review, it's related to another review, but it's equally important. So there's some of the other things that we're working on.
Great. Thank you. Thank you, Governor. Thank you, Chair.
Thanks very much, Ms Payne. Mr Luxale.
Thanks, Chair. Thanks, Governor. Thanks for your update on payments. It's an area I've taken a bit of an interest in. I know you've identified blended rates as an issue in your paper, and we know that small businesses get charged varying blended rates. I think CBA said they charge 1.1%, and I saw one advertised the other day for 2.9%, with some providers including frequent flyer points, point-of-sale hardware, software, as part of what I personally believe to be excessive costs. This is despite your papers publicly showing that average domestic debit costs are under 0.5%. Last week, the ACCC confirmed that while they have powers to investigate excessive charges charged by merchants, they don't have powers to investigate excessive charges by merchant providers.
Yes.
So, notwithstanding your current issues paper and your review, have you or has the RBA ever received complaints or investigated these high blended rates before?
So I'll bring Brad in here in a minute, but we don't have any powers either. We have powers over payment systems and participants in payment systems. And as you know, there is some legislation currently in the Parliament which would expand those because it's quite limited. So there are some payment service providers that we don't actually have any power over. Having said that, the typical way that these sorts of things would be worked out would be competition, so that if payment service providers are charging a lot more, then merchants would seek out, there'd be competition for someone to undercut them and so on. You've identified a problem that I think is an interesting, a very difficult issue, which the payment service providers have found a way basically to make it seem to the merchants like they're not paying anything. And that for us is a challenge, and it's something that we're looking at in the review of surcharging. It's a completely unintended consequence of removing no surcharge rules. And so it's something that's occupying our minds very much. So we don't have powers over merchants either. So the ACCC has those particular powers you were referring to about surcharging, but they're finding it very difficult to enforce it, quite frankly. We've been told that, I've been told that. So it is an unintended consequence of the way things have worked out, and we're looking very closely at it in terms of the review. It's small merchants, and it's fair to say, Brad, that although there's a lot of attention focused on this, the share of merchants that surcharge is actually not that large. It's just that it's the ones that do are really in our face. So I don't know if you wanted to add a couple of words.
What we have seen, and part of the reason why this is, I think, becoming more prominent in the public discourse is because the rate of surcharging, the share of merchants that are surcharging has doubled since 2019, so people are feeling it, and that was one of the considerations that fed into the decision by the Payment System Board to commission this review, so very attentive to this. But the broader point I would just make here is when you think about the payment system, you have to think about a very broad ecosystem with lots of different stakeholders. You've got consumers, you've got merchants, you've got acquirers, you've got card issuers, and then you've got the network operators. And each of them have different interests. One thing that we are very alert to in this review in the Payment System Board is if you focus on one part of that ecosystem, you might set off a chain reaction further upstream that might undo some of the intent of what you were trying to achieve. So we are moving very carefully to consider what the spillover effects from different policy options could be across the entire ecosystem, because one way or another the costs in the system have to get distributed, and we want to make sure that's done in a fair and equitable way.
So up until very recently, blended rates were the default for many merchant providers. I think Westpac, NAB has now said they've turned that off. Do you think they're the reason why we've seen that doubling in surcharging from small merchants? The fact that there's that blended rate there?
I actually don't think that's the reason. It's been true even prior to the increase in surcharging. I think that small merchants prefer simplicity. They don't. So the big merchants all entered into arrangements, interchange plus, quite complex arrangements for how they cost their, how they get charged for their payments. Small merchants value that they don't want to go through reams of information about this charge this for that card and this for that card and this for. They just value simplicity, and there was one new provider that got into the market which basically sort of brought that home, I think. And so I understand why it went in. I don't think it's the reason why surcharging has taken off.
Why do you think it has?
I don't know why it's taken off. I think that, and Brad, you might have a perspective on this, I think the blended rates thing was separate. I think what's happened with the new entrants to the system, not the traditional bank acquirers, but as you've had new entrants come, they've seen a business model, not driven by blended pricing, but just they've seen an opportunity to say, well, I can offer you this and you can surcharge for it. So I just think it's been a lot of the newcomers who've come in and seen an opportunity to have a different business model. It's not the blended rates per se.
Enticing them with frequent flyer points and fancy
that is
equipment.
Exactly. That is a completely unexpected and unwelcome development.
And so that was you said that was the trigger for the review, was that doubling in surcharging. Were you receiving more and more complaints about this, or were you just keeping on it?
We do get some, but I guess they don't direct them specifically to us.
I wouldn't frame it as though that was the increase, the doubling in surcharging was the only. The broader consideration was the surcharging regime was put in place more than 2 decades ago when the payment system looked fundamentally different to how it is today, and so we felt it was time for various reasons to really challenge ourselves to say, is that framework still fit for purpose in 2025? And there's a whole bunch of elements went into that. As I said, there's a lot of things going on impacting different constituents, different stakeholders in that ecosystem. And what we are hell-bent on achieving here, and we won't please everyone, we should be clear about that, because these stakeholders have quite different interests, and there are some very strongly held views that cut completely across one another. So it's going to be impossible to keep everyone happy here. But wherever we land, the one assurance I can give you is that where we land will be absolutely anchored in the public interest.
So there's no real oversight on costs at the moment. Is that something you'll be seeking as one of the outcomes of the review?
Oversight on cost in
so just how we said the ACCC, like you don't have the power to investigate excessive costs, the ACCC doesn't. Like, is that something you'll be addressing in your review? The ability to, I guess, close this loophole or keep an eye on this loophole if the loophole still exists? I know.
So Brad made a really good point here earlier, which was that the payment system isn't cost free. It costs money to operate it. Someone has to pay somewhere, and usually it is the consumer in some way. They either pay it in the general cost. So just like, for example, when electricity goes up, businesses put their prices up. If their payment costs go up, their prices go up. The initial, and this is where this whole thing becomes part of a package. You can't sort of pick out surcharging by itself. The issue here is that the card ecosystem and the way that the card systems work is that competition works in a rather odd way, because if you just let it, and this is why we started regulating interchange, if you just let it at the market handle this, what will happen is that the cost to merchants will get bid up, and they will, via interchange and scheme fees, and the schemes will use that to refund the issuers, who then use that money to give their loyalty points to their customers. And what happens is that merchants, these are must-take things. They can't say, I've not taken cards anymore. So they have to take them. So they're sort of captured. So there's very little competitive pressure on the ability of these fees to rise. When that happens, then that ultimately gets, just like electricity, it gets passed through to the cost to the consumers. So that's what we're trying to address in packages that look at interchange fees and trying to restrain that, keep a lid on interchange fees because competition bids them up. And the no surcharging, forcing the schemes to remove their no surcharging rules was supposed to give merchants the ability to say to the schemes, well, if you're going to charge me that much, I'm going to charge the customer. And for a long time, after we introduced it, that's exactly what it did. It kept fees lower because the merchants had a bit of a lever in their hands to say to the schemes, well, I'm not going to take it if you're going to charge that much. But as Brad said, things have changed. You've got new participants, you've got new business models, and there's a question about whether or not now that is actually working in the way it's intended, and that's the reason why we opened it all up.
So we've focused a lot on cards and, you know, the PSRA looks at digital wallets. I guess looking ahead, my personal fear is that we get a public interest, I mean, I'm not scared of a public interest outcome, but we get a good outcome out of this review. And then as other payment methods pop up or start to become more embedded in the system, like, for example, Chemist Warehouse are starting to roll out QR codes, Amazon are using account to account, that the same issues we're seeing in the card ecosystem just sort of move across to these. What steps are you taking to ensure that debit-style payments, so that is money that comes directly out of your account, are treated evenly across the payments ecosystem?
So at the moment, we have limited, until the legislation passes, we have limited ability to address a lot of these new areas that are popping up.
So until that, so blended pricing or ad valorem pricing could just be added on to account-to-account payments, or in the same unregulated manner.
Quite possibly. We haven't. I mean, the regulation of the interchange fee is something that interchange fees tend to be associated with card payment systems. Some of these new areas, I don't know if they're proposing interchange fees, but if they did, we'll be looking very closely at it.
If their margins are cut, yeah, they will.
We'll be looking very closely at it. But again, we can't regulate the merchants, what the merchants are charging. All we can do is look at what the payment system is charging, whether there are competitive outcomes there, and influence that.
Maybe just add to that, Michele. So there's the interchange piece, and that is very much in scope in the current review. There's also a piece around scheme fees. There's been one of the themes that's come out of the submission is a lack of transparency around the scheme fees, the fees that are charged by the card schemes, and they percolate right through the system. So we're shining a light in our review on the nature of those fees, the complexity of them, the transparency around them, and that's one of the issues that we're working through. But if I could just come back to one point. If we can get wholesale costs or upstream costs down, that reduces the need for merchants to want to surcharge anyway. So that's why I just want to keep coming back to this point. We're looking upstream and downstream. If we can get wholesale costs down, merchants will feel less of a pinch, and then they'll have less of a need to pass those costs on to consumers.
Well, there's no doubt about that. If a small business was charged the same rate as some of the bigger businesses, there'd be no need to surcharge.
That's right.
And so that's good that you're assessing that. A few more questions, if that's all right, Chair. Just on a different topic. In November last year, Ms Bullock, you were reported as stating that Bitcoin was not a currency, not money, and that you didn't understand it and you didn't see a role for it in the economy. What do you mean by you don't understand it? Could you elaborate on that a bit?
That was in reference to the suggestion that the US would establish a Bitcoin reserve and that somehow Bitcoin was going to take a much bigger role in payments in the economy. That's what I understand. I understand Bitcoin.
Right, okay, good.
I don't understand why people think that somehow Bitcoin is going to have this increasingly important role in the payment system. I just don't see it.
Yeah, why is that?
Because, back to the same point, it doesn't serve the purpose of money. It doesn't have a solid value. You can't be guaranteed that what it's worth today, it will be worth the same thing tomorrow. It's extremely slow relative to other payment systems. You can get transactions through in milliseconds in other payment systems. It's not certain in the sense that, as you know, because of the way the ledger works, it's not certain, maybe out until 10, 15 minutes, sometimes not even then. So I just don't see that it's got the infrastructure to be a payment system. It's not a store of value, it's an asset. People regard it as an asset. It has, so for those reasons, I personally don't think that it's going to play a role in when you go to your local pizza shop or go to buy your groceries. I just don't see it.
Do you consider Bitcoin, obviously the more established of the cryptocurrencies, do you consider Bitcoin as being different from meme coins such as the Libra coin or the Hock Tour coin or other coins like that?
Well, I think these are just all personal opinions.
Yeah. Maybe give me the RBA's opinion. Yeah.
Sorry?
Maybe give me the RBA's opinion rather than your personal opinion.
Well, I don't think the RBA doesn't have an opinion on these things, right? We are doing work on a separate issue, which is the potential case for central bank digital currencies, which is a separate issue. The RBA, I don't think, as an organisation, has an opinion on what we should be doing with Bitcoin or what we should be doing with these meme coins and so on. I mean, some people are finding something interesting to do with them, but they're not core to the payment system. They're not something that we regulate, and I don't think we have a particular view. If people want to transact in these things, that's fine. It's just I don't see it as a core part of the payment system.
I guess my fear is, though, and there's been some articles on this, the AMP say that adults under 27 had about 30% of their investments, excluding super in their home, in cryptocurrency. And I think, being young's hard at the moment in terms of cost of living, housing. And so people are turning to cryptocurrency for what sometimes can, in the best case, can be pretty radical gains, but then obviously there's the huge potential for loss. You just need to look at what's happened in Argentina over the last 48 hours. Is this a space that regulators should get into to protect young people's investments, or do you think the future is no opinion?
It's not for the Reserve Bank. We don't have powers in these areas. We don't regulate consumer safety or investments or any of those sorts of things. It's a matter for ASIC, and I would also suggest AUSTRAC.
I mean, where there has actually, the government has indicated a desire to move in a couple of respects. One is to regulate digital exchanges, partly for the protection, the consumer protection piece that you've set out there, Member, and also potentially a licensing regime for stable coins. And depending on the size of that stable coin, that could potentially be, there could be joint supervision between APRA and ASIC for that, depending on the volume of funds in that coin. So those are proposals that Treasury have put out papers on, and our understanding is under very strong consideration from the government, but they're outside of our wheelhouse.
Okay. That's it from me. Thank you.
Thanks, Mr Luxale. I'll now hand over to Mr Wallahan.
Thank you, Chair, and thank you, Governor. And can I apologise for only dialing in? I had scheduled in listening posts in the community before this, so I'll just do this in the car between them, if that's all right. Governor, I'm calling in from Victoria, and I just wanted to get your sense of the Federation, and in particular the Victorian economy, and your general thoughts on it. And then there was a few questions that I was going to ask in response to that. If you could just give your perspective on where you see the Victorian economy and its impact on national inflation.
Well, I mean, in setting monetary policy, we obviously set monetary policy for the whole of Australia. We don't think about separate parts of Australia and think about monetary policy with respect to them. So I guess my first point would be, when we're looking at Victoria or any other state, we're not looking at it from the perspective of, what will we do with monetary policy for this state? It's just to sort of understand the underlying economic conditions in Australia as a whole. On the Victorian economy, and I might again pass to Sarah, but the Victorian economy is not performing as well as some others. I think the unemployment rate in, although it's still not high, it's not as low as some other states. The housing market, housing prices have declined in Victoria, whereas they're still going up in many other states. I don't know if we've got any information, Brad, have we on by state on mortgage?
The share of mortgagees in Victoria who are in or right around a negative cash flow position is a bit higher. It's the highest in the country across the states, but only by a fine margin, and it has followed the general trajectory that all the other states have followed.
Yeah. Just to talk a bit more to the economy, it is true, the Governor's absolutely right that relative to other states, Victoria's looks a little bit soft in terms of growth momentum, a bit soft in terms of the labour market outcome, so a slightly higher unemployment rate than other parts of the country. But I'd also say that it is very usual when you look across the country as a whole for some states to be, have relatively stronger outcomes and some states to have relatively weaker outcomes. That's very typical. That's not just typical in Australia, that's typical of all economies around the world. Very, very rare for you to get an entire country to look exactly the same in all of its regions. And that really reflects the different industrial composition of the regions, might reflect some of the other local settings, different demographic trends and what have you. There's a whole range of reasons why one part of the country might be experiencing things a little differently to other parts of the country. But in a very aggregate sense, it is also pretty typical for them to more or less move together.
Thank you. And I don't know if you saw the recent announcement that Victoria will be shedding more public sector jobs, and given the percentage of employment that is public sector in Victoria is higher, what is your view on that announcement and its impact on unemployment, and then your other considerations in walking this fine line of inflation and unemployment?
Well, again, I understand that it's difficult for Victorians and those people who are going to lose their jobs. I think I saw a number of about 3,000 public servants. And that obviously isn't great news for them. But in the broad scheme of thinking about what's the right sort of monetary policy settings for Australia, that's not a massive change. And it's also true that unemployment is higher in Victoria, but the labour market is still doing pretty well around the country. So, the extent to which those people can get absorbed into other jobs will be very important. Are there other jobs out there on the private sector side that they might be able to look to? So, it depends very much on. It's sort of not a sort of a once-off and then new equilibrium. There's going to be other things that will go. Migration is another. Interstate migration is another thing that tends to happen in these circumstances. So it's very difficult to sort of just take one announcement and say that's going to have this impact. It'll work its way through, and there will be adjustments in the labour market, in migration, and where that all ends up, I can't quite say, but I don't think it fundamentally changes our thinking at the moment.
Thank you, Governor. Again, just reflecting on the many people I've spoken to throughout my electorate this morning, and I will continue. I mentioned that I was going to be speaking to you and asked a few people what questions would they like me to raise with you and how they felt.
These are all the hardest ones.
They are. I think if I could summarise the sentiment about the drop, it was that it was welcome, but it's a drop in the ocean for what they're experiencing. That was the sentiment from this morning. So I guess my question is this. For households, the number on inflation is less material to them than the price level that they are facing as a household. And I think you know that. Right. So how does the RBA factor in the material permanent upward shift in prices in your forecasts for household spending? And if I could put it another way, how long do you think it will take, given the negative shock to real wages, for Australians to start feeling better about the cost of living?
Well, first point to make is you're absolutely right. The price level is the thing that people are looking at, and in the last couple of years the price level has risen by about 18%. So it's substantial, and people recognise that everything they're spending now, it's costing them much more. The unfortunate news is that the price level doesn't go back. We can get inflation down to stop it increasing quite so quickly in the future, but the price level isn't going back to where people remember it being a few years ago. And that's, I think, hard for people to understand, and it makes it difficult. To your point about when will they start feeling better, I think once we're not seeing prices continuing to rise by quite so much, and we're seeing that now, you know, headline inflation, which is the thing that matters for people, because that's what they see. We look at underlying inflation because we think it gives us a better idea of underlying inflation momentum. But what people are facing is headline inflation. And that is at 2.4%, better than it's been in ages, and it's right in the middle of the band. And I think it's going to take some time for people to get comfortable that prices aren't going to be rising at the same clip as they were in the past. So it's not going to be immediate. The other thing is that they will start to feel better. Their real wages now are rising now, and they weren't in the past. So they're starting to rise, and that's partly reflected in our forecasts, which see consumption not right now, but in a little bit out. Those real wage increases, because inflation has come down and wages are still increasing by about 3.5%, that will start to reflect in a lift in consumption. So I don't expect they'll start feeling better immediately, but I think if we can keep inflation back down in the target band, and wages, real wages are rising, I think people will start to feel a bit better over the coming year.
And Governor, my final question then will be, which is a reflection on us as legislators. If prices aren't coming back, and if real wage increases, are a difficult challenge for us, is the goal for us is to try and improve Australia's productivity again. That's the pathway
Correct.
Back for families to feel better. That's our number one challenge.
The number one challenge, I think, you're right. The only way that we can have sustainable increases in living standards is if we get increases in productivity. You're absolutely right. So that's sort of where government has to play a role. Our role in that, as I said in response to a question earlier, is if we've got low and stable inflation, that's going to maximise the likelihood that businesses, and consumers feel comfortable and that businesses can invest in productivity improvements. If we can give them low and stable inflation, that's an enabling factor for them to get onto that. So, yes.
Thank you, Governor, and thank you, Chair, and everyone. I'll head back to the listening posts now, so I appreciate you giving me the time.
Enjoy.
Well, thanks, Mr. Wallahan, and thanks for providing some questions from the field. Hand over to Deputy Chair.
Thanks, Chair. Just a couple of questions on cash distribution. So is the RBA confident that the banks and Armour Guard will be able to do a deal by June? I think we've got the emergency funding expiring at that time. And what are the options if a deal isn't agreed on by that time?
Yeah. I'm never confident in this cash space at the moment. I know the banks are working very hard on it, and I know that they are working with Armour Guard. We have a very specific role to play, and we're looking to see whether or not there's some things we can do to help, but ultimately we don't have a role in this retail cash distribution area. I think they have to find a solution by June. If they don't, then we're in trouble. So I think that necessity will mean that something will be done. I don't know what it is. My own, the bank's view, and I think the view of the regulators broadly, is that we need to think longer term about this. At the moment, we're in trying to solve the short-term issue to make sure that cash is available. It's available in retailers, that people can use it, that people can access it. That's the immediate short-term issue. But we've got to think that cash is going to be around probably for another 10 years, and we've got to find a way of moving to a new system that means that distribution of cash can be undertaken and viable. Now, there's a number of options that could get you there, but the bottom line is that cash distribution is someone is going to have to, if you don't want the consumers to pay, then someone has to pay, and it's going to be difficult to figure out how it is subsidised, because that's what we're asking for. Normally what would happen in a circumstance like this is that if the costs are going up, then what would happen is people would have to pay more to use it. I think the idea that people pay to use cash would not go down well. So that means that in order to make this particular situation viable, someone is going to have to cross-subsidise consumers in cash. And that is, I think, where we need to think about the longer-term solution. Where do we find this cross-subsidisation? Is it the banks that have to take it on and basically provide cash services to their customers and cross-subsidise that? How is it going to work? And we don't have a solution as yet.
Can I just go into thank you, and I agree there's probably only small elements that the RBA can actually play in that part, but what might some of those elements be?
So the main element we're looking at the moment is that we pay interest so banks take cash out from us and they hold it in various storage places so they can get it to where they need to get it. We pay interest on parts of that. So they have to hold it in certain ways under certain conditions, and we will pay them interest. So that encourages them to have money out there. We're looking at whether or not we can expand that interest compensation to additional areas, which would encourage them further to hold cash out in the community so they can get it. So that's the main thing we're looking at the moment.
And just going on to the issue of what's been raised in the context of particularly regional bank closures is there is a cost to cash already. We don't see it. It's usually bank charges or somewhere it's carried. But what we're talking about is this increased cost. And it's that difference that we're trying to work out where that's carried. Do you think banks are doing enough on this? I honestly, one of the biggest feedbacks I have, particularly in small towns, Pittsworth and Oakey, where there's where none of the majors exist anymore. We used to have 4 major banks; they're all gone. We're left with an ATM, and we're worried if that's going to go. Are banks doing enough to keep that open? And you're talking about a transition period that could be quite some time yet.
Yeah. Look, I think the banks, my understanding at least, is that they have basically agreed to a moratorium at the moment. The challenge is that...
It's about the third one I've heard.
Yes, yes. I think the challenge is that the banks, on the one hand, are commercial institutions. They've got to work for their shareholders and so on, but we also expect them to meet some sort of community service obligations, and cash is one of those, I think. Branch access is another. The difficulty with moving to a much more digital payment system and banking system is that increasingly the person-to-person element of that is getting smaller and smaller. And there's a group of people who really want to use that, but they are just becoming a smaller and smaller and smaller group. And so there's a real tension between effectively servicing them at a much higher cost than you're servicing everyone else. So the bulk of your customers are basically cross-subsidising the group the much smaller group. So there is a very big challenge here, and the cash system is an example of it. But the digital side of things, I can't remember the last time I went into a bank. There's a large portion of the population that just have gone purely digital, but there's another portion, and they are often the more vulnerable people, lower income people, the regional people. They're the ones that are being squeezed by this, and it's the economics of all this fixed cost infrastructure increasingly supporting a smaller and smaller group of people. So it's very challenging.
So following the meeting at the RBA last week, is the RBA confident it can redraw the 20-year-old cash distribution agreement with Westpac to include the other banks and to spread the risks with cash held in those Armago depots?
Well, that is in the hands of the banks at the moment. There's the commercial cash distribution issue, which is separate than what we were talking about earlier. That is something that Westpac has supported. My understanding is that the other banks are looking at how they actually support Westpac in that. We are keeping an eye on those discussions. Again, it's not in our bailiwick. We're not actually in that retail cash distribution area, but we are in contact with the banks, and we do understand that they are all taking this issue very seriously.
I guess last question is just around what the future of cash really looks like within the economy. You talked about a sort of a 10-year horizon. I think this is you identify some of those cohorts that hold it strongly that I think would like to see a very different response. But look, what are the big drivers, and what's going to change that conversation in the short term and the long term, I guess?
Well, I know there are a lot of advocates for cash out there, but you only have to look overseas to see that it's not making a rebound, really. I mean, some other countries, particularly the Scandinavian countries, have seen cash use decline much more substantially than here. They've got even more issues than we have. What's going to turn it around? I don't think anything's going to turn it around. I think it's on a long-term decline, and the reason being is that people find making electronic payments just much more efficient. And it's true also that merchants find it much more efficient. And if you look at recent studies, there was a recent study done. It was done for MasterCard, admittedly, but I think it was a good study. It highlighted that the costs to merchants of cash are actually higher than card payments, which is ironic. They surcharge card payments. But it is costly for merchants. It's costly in terms of all the back office costs of counting it, taking it to the bank, particularly if you haven't got a branch anywhere near you. There's theft costs of delightfully called shrinkage, I think, in merchants. So for all of those reasons, I think that the long-term decline of cash is reasonably inevitable. What we have to do as a society is to decide how we want to manage that and how we want to ensure that those that still rely on it for good reasons still have access to it and how we're going to provide that to them. And it has to be a conversation as a society on that, I think.
Do you think most people are aware of the cost of cash?
No, I don't. I don't think that. I don't even think a lot of merchants are, quite frankly. I don't think they realise how expensive it is for them to actually be taking cash payments. I don't think consumers realise it either, because normally where you understand costs, it's because you're facing a price. The only price that consumers really face on cash is ATM withdrawal fees. And that's reflecting the fact that someone's got to get the cash out there, put it in the machine, refill it when it runs out. Those are the costs that are involved there. That's the only place where people face a cost of cash. Otherwise, I don't think people realise that it costs.
Thank you very much.
Thanks. Just a couple of questions to finish up. You talked about the fact that we've gone through quite a historic change recently in terms of the way the bank will make its interest rate decisions. There have already been a number of changes from the review that have been implemented. So for some time now, we've been seeing the bank hold less frequent meetings but more detailed deliberations at each of those meetings. We've also had a change in the communications regime where you've held a press conference following each decision. And in a sense, this is the next step, an important one. So you talked about this a bit in the opening statement. I'm just wondering if you could talk us through a little bit in more detail what changes the bank is making to accommodate the new board structure and how you see it working.
So there's been some things we've already done, as you've highlighted, and they were mainly structural. The meeting types. We've made a lot of changes to the way we write our papers, the sort of information we provide the board. So we provide much more explicit alternatives and scenarios. We talk through risks and judgments a lot more. Hopefully people will have seen that through the statement on monetary policy that we've committed. We haven't yet, but we are committed to uplifting. Another recommendation was uplifting our modelling capacity and our analysis. So we have and our analysis of financial conditions and so on. So there's a number of areas in which we're going to have to uplift our capabilities in our policy areas to deliver more of this. So there's that. With the two-day meeting, we have already, I think, seen much more engagement from the board on alternatives. So, you know, we always did discuss alternatives, but I think that's much more active now. And I know that, you know, as chair, I try to actively bring out, we bring that out in the papers, we try to actively engage. So there's that as well. And the other thing that we are doing is, and again, this is another new bit, we've setting up a monetary policy strategy team. One of the recommendations of the review was that we have a specific team to think about this. So this is the idea that this team will bring together analysis from all the different areas, Sarah's area economic, the financial markets area, the financial stability area, and think about how that all feeds into not just the interest rate decision today, but how an interest rate decision here fits into the board's strategy going forward. So there's going to be a lot more focus on that, and that's in progress. We haven't set that team up yet, but that's another thing that we'll be doing through this year, setting up that team and trying to embed it into the processes of how we deliver material to the board. So there are a few of the key things. What have I missed?
I don't know, but one of the interesting challenges for central banks is that people look to them for clarity, to cut through the noise, cut through the politics, to cut through the uncertainties, and to tell people where the world's going. And, you know, in the best situation, we can do that. And, Governor, you covered this morning how, you know, after a period of uncertainty, the narrow path seems to become slightly wider. Inflation has come down and employment growth has been sustained. But alongside that need to provide clarity and cut through, we also have to find a way to talk about the uncertainties and the challenges and the difference of perspectives. And central banks globally are finding this, that as you open up and talk about those alternatives, people will sometimes say, hang on a minute, you're supposed to be the people who give us certainty here and give us clarity. And that balance between those two things, we've had a version of that in Australia in the last few years, but every central bank has been through that, is a really difficult one. In some ways, one of the things I've found very powerful from the board here relative to the committee I've been used to is that it has a broader range of people with a broader range of backgrounds. And a number of them have said, do you know what, as we start talking more about uncertainties and alternatives, this starts to feel more like the conversations that we have on other boards that we're on, where if you're on a major energy company or if you're in a major retailer, the whole time you're making decisions under extreme uncertainty. Do we open a factory here? Do we close a factory there? Do we promote our product in the United States or do we not? And actually central banks, although we're always saying we want more information, probably have more data and more facts at their fingertips than most companies, and I think most households as well. When we make key decisions, we're going to get married, are we going to, move 10,000 miles to another country and throw yourself at the mercies of a different parliament, just to use one example. We are in some sense growing up into that world of indecision. Now, as we start to be more open about those uncertainties and those challenges, we find sometimes that people are saying, oh, yeah, we thought you were going to be clear about things. And so we're having to move that conversation, I think, into a new space. And actually the rate cut has been a really good example there, where some people have said, well, why aren't you being clearer about how you see the labour market? Well, that's because there are genuine debates about it, and we're trying to be more open about it. All we would ask is that in that sort of conversation, people recognise that we're trying to be more honest and clear with people, and that will sometimes mean that we're clearer about things, but it will sometimes also mean we have to say, do you know what? Reasonable people can differ on this, and we're going to be more open about that uncertainty. Sorry, but that's life.
No, I think that's a really important point. And look, I think you and I spoke about uncertainty versus risk last time, and given that we've got 4 minutes left, probably won't reopen that can of worms. But look, given that all the members on the committee are dealing with our own personal uncertainty in the next little while, we might or might not revisit that soon. Look, I just had two very quick questions on another complex topic, and that's productivity. And I without wanting to go into the drivers Australia might look at to raise productivity, I firstly just wanted to ask, we have seen a drop-off in productivity in Australia in recent years, but I just wanted to clarify, but that's also something that most other, if not all other advanced economies have experienced over that kind of last 10, 20-year period.
Yes, it is. It's been a decline pretty much across the board.
Yes, we actually have a chart in the Statement of Monetary Policy right at the front of the economic conditions. I won't try and draw in your heads now, but essentially through the last couple of years, all advanced economies have seen a pretty similar trajectory to what we've seen here in Australia, with the exception of the US. And so we are genuinely asking ourselves why they're exceptional. And for us, it matters in the context of our forecast and the outlook. But it is a broader question.
And it has been a long-term decline, like over decades. It's sort of, you have seen it decline.
So there is something, leaving the US to one side, deep and structural there that probably needs a lot of unpicking.
It does appear so, yes. It's not a uniquely Australian problem, but it is a problem nonetheless.
So the other thing, again, just 3 minutes left, but I just wanted to kind of touch on the fact that I think that you've made the point today, but also on previous occasions, that we need to look at productivity in a structural sense, in that, if we're going to look at, for example, wages growth over the long term, then you think about, you've framed it in terms of 2.5 plus productivity, but there's a number of ways you can think about it, but certainly productivity is a key factor to bear in mind. I guess the question I had is, we should also be a little bit cautious, or, I don't know what the right word is here, but humble's not the right word, but we also have to acknowledge, I suppose, that we can probably measure productivity in some parts of our economy in a more straightforward way than others. And certainly I would argue that services are more difficult, full stop, but certainly the non-market economy, which is a very important part of our economy, is a very difficult part of the economy to measure productivity in, which isn't to say that we shouldn't think about productivity in that sector, but if we are going to think about productivity and benchmarks, we also, I think, have to acknowledge that it's just hard to pin down.
I'd absolutely agree, and I think, you know, to your point, I mean, I think health is a really good example there. I mean, how do you measure output? You know, you can have less nurses and worse quality care, or you can have more nurses, perhaps with much better care and more productivity, but it's very difficult to measure.
I mean, we're trying to measure outcomes ultimately, and I think all of the statistical agencies are trying to move down that path, but it's not easy.
It's very difficult.
It is very difficult. And just to add, the National Accounts way of measuring productivity is a really strict, internationally comparable measure. All countries do it the same way, and that's helpful because then we can compare. But it knowingly strips out much of what you're talking about. And, you know, there are other ways that you can measure it. The ABS do report on those, the Productivity Commission as well. So I would always caution against just looking at one single metric, particularly in some of these sectors, because it is so difficult.
Great. No, well, thank you very much for appearing before the committee today. These are always very well followed and important hearings. The committee secretariat will be in touch with you in relation to any matters arising out of today's hearing. You'll be sent a copy of the transcript of your evidence and will have an opportunity to request corrections to any transcription errors. I now declare today's meeting closed.
Thank you.
Thank you.